both Chairman Powell and many of the significant banking personnel and economists say we're not in a recession. We've created 9 million new jobs so far, just since I became president. Businesses are investing in America at record rates, Foreign business like SK and others are investing in America. Hundreds of millions and trillions of dollars, sum total. That doesn't sound like a recession to me.
That's President Biden assuring the nation that despite recent economic stresses, the country is not in the midst of a recession. Yahoo Finance senior columnist Rick Newman here with that story. And Rick, you say GDP decline now back-to-back quarters. Technical definition of a recession should not matter to the Biden administration. What?
I don't think that, well, first of all, many Americans already think we're in a recession, and they thought that before the GDP number, and they don't think that because of GDP. I don't think normal people pay much attention to GDP. But there was a poll by Morning Consult 2 weeks ago that found that 65% of people say they think we're in a recession already. And it's not because they understand how important it is if the entire economy shrinks by 0.9% from one quarter to the next. That doesn't matter to anybody. But because gasoline is up 50% during the last 12 months, and groceries are more expensive by 12%, and rent is going up, and things are going up, and that people are falling behind in terms of how much their incomes are going up relative to inflation. That is totally the thing that matters to President Biden and to most voters. And I think this GDP report, it wasn't a great report, but I think it's going to wash right by, and we're going to go back to everybody's worried about inflation.
Rick, how much of the strong jobs market do you think could potentially help Biden here? Because he's searching for anything. He's trying to convince Americans that we're not in a recession. At least he has that piece to hold on to.
Yeah, so he's right when he says the job market is as strong as it is. And we just had Alan Blinder. You guys were talking with the great economist Alan Blinder. I mean, like, we don't have recessions where we add jobs. I mean, that's not a thing that happens. And if that's a recession, then we should enjoy it, because that's a good thing to have. But, you know, employers have added 2.7 million new jobs just this year. That's during those 2 quarters when the economy was shrinking. So, I mean, everybody needs to try to get their brain around that. The economy is shrinking, and we're still adding almost 3 million new jobs in 6 months this year. So this will help. I think this will help Biden when inflation gets better. We have seen gas prices come down, I think, almost 70 cents a gallon. They're now below $4.30. I've been saying for a long time, what will help Biden immensely is when voters start seeing gas prices start with a 3, not with a 4. But if that does happen, then I think consumers will start to believe maybe things are okay. If we can start feeling we can afford groceries more easily, we can afford to drive more easily, and job security. Those are the 2 things voters care about. It's inflation and job security.
Yeah, he's going to need at least 2 positive inflation prints, a lot like the Fed.
Probably.
To have any luck.
But it's already helping that gas prices are coming down.
No question.
Yeah, 428 today. We'll see whether or not we get below.
We're watching every penny.
We learned this morning that U.S. GDP declined for a second straight quarter, shrinking by 0.9%. It's the second consecutive decline in growth, heightening the debate around a U.S. recession. Joining us now for more on the state of the U.S. economy is Jared Bernstein, member of the White House Council of Economic Advisors. Jared, it's always good to get time with you. As you know, there's a lot of sort of discussion here. Is it a recession? Is it not a recession? Does it matter if it's a recession, if people feel like it's a recession? And I think that last question is probably the most pertinent here. As you talk about messaging from the White House, most Americans are convinced things are bad right now, whatever you want to call it.
I do think that's the right way to frame this up. How are people feeling about the current economy? And look, there's no question that unacceptably high inflation, as the president continuously presses on that point, is upon the land and really discomforting to family budgets. But at the same time, we shouldn't forget that we're coming out of a breakneck growth pace in 21, where GDP growth was many times above trend. Now, as the Federal Reserve steps on the brake to slow the economy down and fulfill its role as the first and foremost inflationary fighting institution, we've expected to see slower GDP growth. But the key is, how are jobs faring? How's the labor market faring? How's consumer spending? All of those remain in solid territory, and that is a very important backdrop, a tailwind in an economy with, as you've correctly pointed out, has significant headwinds as well.
Jared, are we looking at right now a pre-recession?
You know, the recession question is one that gets answered by the National Bureau of Economic Research, and they go back and they look at a set of variables. Probably the most prominent ones are payroll employment, so that's been very strong. Industrial production, that's up. Consumer spending, real consumer spending, up 1% in today's report. Now, how do you get positive consumer spending and a negative handle on GDP? Inventories are a big part of the story. They took 2 points off of GDP growth, but that doesn't mean that inventories fell. What it means was that the inventory buildup slowed. In fact, inventories grew by more than 80 billion, but that's slower than last quarter, and that shows up as a negative in GDP.
If we were to tip into a real recession or fully feel kind of the brunt of a recession, from everything in employment all the way through how consumers are spending, how businesses are kind of gauging their own ability to move forward and operate, does the White House believe that the Fed should kind of dampen its stance on how quickly they're tightening and being more aggressive in policy?
One of the hallmarks of this White House, in contrast to the prior one, is that we stay way the heck out of the Fed's knitting, especially when it comes to more granular calls like that one. As I've noted, more importantly, the president has emphasized Fed independence is a critical component of letting them do what they have to do to attack this unacceptably high level of inflation. What I would tell you is that the backdrop that Americans face in terms of the strong job market, 3.6% unemployment for 4 months in a row, 375,000 payroll gains on average over the past 3 months, that certainly creates a really important buffer, a backdrop for those elevated prices putting pressure on family budgets. Budgets, by the way, that are somewhat supported by strong balance sheets. I think that's one of the reasons why we got a 1% plus in consumer spending in this report. I think key looking forward, by the way, are some things on the legislative agenda. Today's one of the first days I could come out here and talk about this Inflation Reduction Act, the reconciliation plan. Huge opportunities for investment. The CHIPS Act, huge opportunities for investment in key areas of American domestic semiconductor production. So I think those actually are very promising opportunities for the future.
Jared, with inflation still staying high and more companies announcing hiring freezes, should the average American household be cutting spending?
The average American household, according to this GDP report with its negative handle and everything, increased spending in the second quarter by 1%. Now, how does that happen? Well, another little nugget buried in this report is aggregate compensation. That's all the earnings growth that people have in the economy. That's the trillions, not the average wage. That actually beat inflation by a touch in the quarter. So if you have a strong labor market supporting strong aggregate compensation, and you have balance sheets, thanks to shots in arms and checks in pockets way back in March of 2021, that are still in quite good condition, you're going to support consumer spending even while these other economic headwinds are in play. So I think both of those forces need to be reckoned with if we're trying to understand the dynamics in this economy.
Jared, you mentioned the reconciliation package and the agreement that the White House has gotten with Joe Manchin. And I want to dig into that a little bit because on the one hand, you have in particular all of these climate and energy incentives, which I know that people on the left have been working on and pushing for a long time. Some of that being paid for by this minimum tax on corporations of 15%. Has the White House gotten a lot of pushback from corporations on that? And is there any risk to economic growth and spending on the part of companies from the institution of that tax?
Well, let me start by saying that the threshold for that tax, and I think anytime we talk about it, we ought to probably lead with this, is $1 billion in profits. I believe it's averaged over the past 3 years. And so that's a really important, I think, piece of that minimum tax. One of the things that we've continuously stressed, ever since we were talking about President Biden's highly progressive tax proposals are that they don't hit anyone under $400,000 of income. Now, look, this is called an Inflation Reduction Act in no small part because these tax increases do a couple of things. They very much, particularly this book minimum of 15%, they very much improve tax fairness, which has been sorely missing from that part of our tax code. And they lower the budget deficit, which is not only useful for our fiscal accounts, but it's also disinflationary. So that's, I think, one of the reasons this bill gets its name as the Inflation Reduction Act.
Just additionally, while we have you here, because it's helpful to know or at least understand what's changed significantly from the first time elements of this bill were introduced to this point now that has finally gotten Senator Manchin over the line.
Well, we have a lot of negotiators that have been working really hard on this. Obviously, President Biden has always been in the mix. The Democrats, Leader Schumer, I wasn't part of those negotiations, so I have a readout of all the personnel. What I can tell you is that I've worked with Joe Biden for a long time, and he just has never stopped pulling legislative rabbits out of hats. So, look, this is Washington, and if you have a president who believes in keeping hope alive, sometimes you're going to get a result like this, and it's a very pleasing one. We have to make sure that we continue on track and listen to the president's admonition to get this to his desk as soon as possible, because trust me, he is anxious to sign it.
Federal Reserve has officially raised interest rates by 0.75%. That was largely as expected. Again, markets pricing in a chance of about 75% chance of that happening. Now, when it comes to changes to the statement itself, really not much change when you talk about recent indicators of spending and production have softened. That's the only new sentence in the statement. Again, I'll read that one more time. Recent indicators of spending and production have softened. That might be the closest that we'll get to the Federal Reserve acknowledging that perhaps there is a slowdown happening in the economy, not en masse, but interesting to note that language is in the statement. But beyond that, really nothing else in here. The Fed continuing to point to Russia's war against Ukraine as one element to upward price pressures. Of course, the Fed sees a demand side of that as also part of the picture, which is the reason why it feels it has to continue to raise interest rates. Keep in mind, the Fed is now targeting interest rates between 2.25% and 2.5%. And they say, quote, they anticipate that ongoing increases in the target range will be appropriate. Translation, bus doesn't stop here. That language was the same as we had seen from the Fed in June. But beyond that, the Fed continuing to acknowledge food and energy prices are high. Job gains do remain robust. So the Fed's balancing act as it tries to raise interest rates without triggering any sort of job losses does remain. But again, the big headline today, 0.75 percentage point increase from the Fed, second in a row. Decision was unanimous. Guys?
Brian, just talk to us about the unprecedented action here from the Fed. It's been quite some time since we've seen the Fed get so aggressive. And then, of course, just your perspective on what this means that we will likely see heading into the fall, because inflation is still at its highest level that we've seen in about 40 years.
Yeah, well, when we talk about just the inflationary reaction, we have to remember that the Federal Reserve has been pretty insistent that it can't just simply stop raising interest rates here. For what it's worth, where we're at right now at about 2.25 to 2.5% is roughly the estimate of where economists say is neutral, meaning that any further interest rate hikes past this point could have more bite into inflation, which is going to be very important when you consider that the last read we got on inflation on CPI was 9.1% on a year-over-year basis. That hasn't shown signs of letting up quite yet. However, what we don't know is what is the Federal Reserve going to do next? There's nothing in this statement that says, well, in the next meeting, which, by the way, is going to happen at the end of September, is it going to be 50 or 75 or 1 percentage point? We don't know. And that's why all eyes are going to be on the Fed chairman's press conference at 2:30. What will Jay Powell tell us? Will he give us guidance on what happens next? That's going to be very important to see how he can shape inflation expectations with these recessionary worries out there.
And we know that before, when we got that CPI data that came out, people were wondering, look, could it be 100 basis points? But obviously closer to this decision, we did see that 10%. But it's interesting to see that this was a unanimous decision. Was that surprising to you?
Well, it was surprising when you consider that you actually had one member dissenting from the last decision. So in June, when the Fed made the abrupt change last minute to go from 50 basis points to 75 basis points, you actually saw Esther George, the president of the Federal Reserve Bank of Kansas City, dissent against that. She wanted a smaller rate hike of the 0.5%, half a percentage point that markets were expecting prior to that meeting, which, by the way, was a bit of a surprise because those Fed watchers have noted for some time that she has tended to favor larger interest rate increases as opposed to smaller ones. But in this decision, which, by the way, she's still a voter, she did go along with what the Federal Reserve ultimately went with, which was that 0.75 of a percentage point increase. So, again, everyone's on board. Keep in mind, we also have a few new members of the Federal Reserve Board, Michael S. Barr, and then also Susan Collins from the Boston Fed joining the committee between June and July. So they were also in line when it comes to that. Of course, we'll have to hear all the Fed commentary after this meeting to see if the other non-voting members of the committee also supported this decision.
Yeah, really surprising given the amount, Brian, of business leaders and analysts who wanted a 100-point hike. So I expect the name Janet Yellen to pop up in this press conference, in particular when defining a recession. How do you expect the Fed chair to tap dance around the actual definition of a recession given the GDP number coming tomorrow?
Well, Dave, we'll have to see in about, 27 minutes or so. When we talk about Jay Powell's approach to all of this, though, you would probably expect him to say what he's already been saying, which is the Fed is going to do its part to try to land this plane without any issues. Of course, that seems to be a picture that's getting a little bit gloomier and shows that the job of actually a smooth landing is going to be a lot harder than the Fed had projected perhaps earlier in the year. Now, of course, the Fed is going to say, at least for right now, it is going to continue to raise interest rates. But again, who knows how long and persistent the war in Ukraine is going to be on energy prices? Who knows what the inflation expectations are going to look like as Americans continue to talk about the R word? How does that shape in any sort of behavior when it comes to consumption or businesses when it comes to investment? So I think the Fed chairman in a few minutes is probably going to say something to the effect of, look, as far as their knitting, they stick to interest rate increases. And we know that up until today, monetary policy was still very, very largely accommodated because it was below that 2.4% that people estimate as still stimulative to the economy. After today, that might now start to be restrictive. So that's probably going to be a talking point. And again, we'll have to listen in about 25 minutes or so.
Yeah, and Brian, it's also a tough balancing act here with the Fed because the other question out there is how much hiking can the economy absorb at this point? Because the Fed still very aggressive as we see very high inflation, but the economy is slowing down a little bit. So it'll be interesting, I guess, to see how Jay Powell is able to walk that line as well, because he doesn't want to get too aggressive in the fact that then that could potentially spook the markets.
And that is exactly the reason why the Fed didn't just instantly raise interest rates to say 3.5% or 4% already, because the markets are not quite ready for that. And in fact, one big difference between this meeting and the last meeting is that for the first time, you're starting to see the 10-year yield price in the chance of a Fed cut at some point. Now, some of this may have been natural because, the Fed couldn't raise interest rates forever. But as of the last meeting, you still saw the continued rip up in the 10-year. And essentially, over the last 6 weeks, you have seen the 10-year fall down by about 75 basis points. I'd be interested to see, I don't have a computer right in front of me, of what the 10-year is doing right now. But of course, with that action over the last 6 weeks, that is bond market traders pricing in a high likelihood that at some point the Fed's going to have to do a U-turn on all of this. How abrupt is that going to be? I think that turn is going to depend on how hard we go into a recession if that does end up happening. You have a lot on Wall Street saying, well, maybe in the second half of next year is when that U-turn happens. But look, I'm starting to see some reports and some analysts that are saying, hey, it's possible that they're going to start to pull that call up to maybe the first half of next year.
You're seeing a bit of a reaction here in the 10-year as we pull that up. It's still not a heck of a lot of movement, at least just yet. I don't think you can save off just about 2.7%. All right, Brian Cheung. We want to bring in Federated Hermes, a senior portfolio manager, RJ Gallo, and principal Global Investors Chief Global Strategist, Seema Shah. It's great to have you both. Seema, first to you. Let's start with the equity reaction that we're seeing. Yes, adding to some of the earlier gains, Dow now up nearly 100 points, I believe, if we can pull that up right now. You can see the Dow up 71 points, S&P up just about 1.2%, the NASDAQ giving up actually some of its earlier gains. What's your reaction to what we heard from the Fed, the 75 basis point hike?
Well, look, I think the 75 basis point was fully expected by the market, although there had been, of course, that speculation after the CPI number of a slightly bigger 100 basis point hike. They have become very, very clear in what to expect for this month. Now, of course, for the press conference, it's all going to be about how is the Federal Reserve thinking about the slight slowdown in growth coming and how quickly do they think they're going to get to the kind of the next restrictive territory. I expect there will be questions about recession and potential rate cuts, but I don't think it would be in Powell's interest to almost give a full answer to those questions.
And RJ, your reaction to it being a 75 basis point hike and what you're hoping to hear in the press conference from Jay Powell.
75 was fully anticipated. The brief flirting with 100 basis points, was very brief. So I don't think there's anything surprising at all in the 75. I would echo the sentiment that Chairman Powell faces an interesting task. The bond market is pricing in easing basically by summer of next year. It's pretty unusual in the history of Fed hiking cycles for the market to price in and ease so quickly after the expected peak in the Fed funds rate from the tightening cycle, which should be like in January or February of next year. The market has gotten very convinced that a Fed that was slow to fight inflation is now fighting it with all of its talons out, and the inflation will come down. Market might be a little too optimistic on that front in pricing in and ease that quickly, and it'll be interesting to see how Powell answers those questions. I bet he'll talk about data dependency and that inflation is still much too high, sort of subtly pushing back against the argument that an ease is coming by next summer.
Seema, of course, prior to last month, the last 75-point hike was 1994. We forget the context on just how much Fed tightening is doing, and you have some numbers on that, just how much they're doing in such a short period of time, historically speaking.
Yeah, it's very interesting. In the space of 4 months, so since they started hiking back in March, in the space of 4 months, they have hiked just as much as they did through the entire 3-year period of 2015 to 2018. So this is turning out to be one of the steepest hiking cycles that we have seen in recent Fed history. And I think it goes very far to show the kind of fight that they are on. They have to, as was just heard, they have to put everything they have into bringing down this inflation rate. And I agree. I think this is going to be very painful. It's going to be extremely slow. And the market might be a little bit too optimistic if they're expecting rate cuts as soon as next summer.
Well, Seema, exactly how painful do you see it potentially getting?
So we are expecting a recession to hit the US economy in the first half of next year, probably the first quarter of next year. We are actually expecting the Federal Reserve to continue hiking in the beginning of 2023. So we're expecting a peak rate of 4.25%. That is above market expectations. And unfortunately, with that kind of tightening on the way, it's going to be very difficult for the US economy to avoid recession.
And so, RJ, in terms of the factors that are outside of the Fed's control, what are you watching most closely?
Well, the supply shock that is apparent in many sectors of the economy, the supply chain problems, whether it be offloading at ports, whether it be the fossil fuel complex, which was certainly aggravated by the terrible events that are going on in Ukraine. The Fed can't control those things. They can't unkink the supply chain. They can't suddenly come up with more natural gas to flow to Europe or more oil on world markets. But I think what's important to realize is the Fed knows it can't affect those things. They're watching them too. What they can affect with interest rate policy, with monetary policy, is the level of aggregate demand and where that aggregate demand meets that attenuated supply. So I think that they're acting in the correct manner. The policy error that was transitory is in the past, and the Fed is now focused very much to prevent the inflation problem, which is acute, highest inflation in over 40 years. Working to prevent that from becoming endemic in the economy where inflation expectations become much too high and the Fed has to absolutely tank the economy to address them. We do think a recession is a real risk. It's not quite our base case. We think we might skirt by the recession. It's an extraordinary time. The unemployment rate is also at about the lowest in 50 years. So we have a lot of economic strength coming into this that can suggest that the economy could decelerate just enough to allow this inflation. I still think no ease is coming by June of next year, but I don't know that our base case is a recession either.
Seema, we eagerly await the words from Jay Powell, and certainly he'll be asked about the coming GDP number, which many expect to be negative, therefore the technical definition of a recession. How do you expect him to walk that tightrope of whether we in or whether we're not in a recession?
I mean, I think he'll just point to the labour market. We know that it's an extremely strong labour market, and when you're seeing payrolls averaging at about 375,000 per quarter, that is not the official definition of recession. You need to see weakness on consumer spending, retail sales, and certainly the labor market as well. And we're not quite reaching that. So although this would be, as you said, two quarters of negative growth, to them, that won't quite qualify as a recession.
Seema Shah, RJ Gallo, great to have you both on this all-important Fed Day. Thank you both.
Americans are reacting to inflation that has reached highs not seen since 1981. A new survey conducted by Yahoo Finance and our friends at Morning Consult shows that while gas prices are getting the headlines, it may not actually be the biggest inflation concern among Americans. Joining us now with the poll results and political perspective, Yahoo Finance's own Rick Newman, senior columnist here at Yahoo Finance. Rick, what do we know from the results so far? What were we able to extrapolate?
Well, I've paid a lot of attention to how people feel about gasoline. One of the things that surprised me here is people are obviously concerned about the price of gas, which hit $5.02 in the middle of June. But the majority in this poll actually say they're confident they can afford gas right now. 63% said they're able to afford gas right now. It's interesting because a significant number of people say they're worried they may not be able to afford gas in the future. So that's people telling us, yeah, they can afford it right now, but they're concerned things are going to get out of hand a month or two from now and the prices are going to go up and they're not going to be able to handle the cost of gas. So people are worried things are going to get better. That's one of the things that clearly comes across here. But there are other things that people have a harder time paying for. They are struggling to save money or put any money into retirement savings. And then childcare is the one thing where people say they have the lowest confidence they can afford childcare today for those people who need it. Only 42% said they're confident they can afford childcare. And of course, for families with kids, they probably spend a lot more on childcare than they do on gasoline. So, we in the media, we've been fixated on gas prices, but families have a lot of other budgetary concerns.
Indeed, they do, Rick. And I wrote up what the poll found with as it pertains to back-to-school supplies. 50% of those polls said they won't be able to afford back-to-school supplies, and they're going to have to cut back on a vacation to afford those supplies. And another 28% said they may not be able to afford school trips for their kids. So you put all this together, none of this could be good for the president, right?
Well, I mean, this is a bit of a Rorschach test, honestly. So we do have a majority saying they can afford most categories of things that ranging from necessities to non-necessities like vacation. But there clearly are families that are under stress. Now, that's always true, and this is the first time we've done this with Morning Consult, so we're going to build a baseline here over time. But yeah, I mean, look, there are families under stress, but I think once again, people really worry that things are going to get worse a few months from now, and that could be inflation gets worse, or we have this recession that we've been trying to talk ourselves into, and that people feel maybe their incomes are not safe and their jobs are not safe. So one thing that comes through crystal clear is people are just in a bad mood, and that is a big problem for President Biden.
All right, Yahoo Finance's own Rick Newman there breaking down the results of our latest survey with Morning Consult and Yahoo Finance. Thanks so much, Rick.
Hi, guys.
But again, inflation is not just a domestic story. It's also part of the global growth story. Another news headline that crossed this morning, the International Monetary Fund painting a grim picture for 2022 as it again slashes its forecast, now projecting 3.2% growth this year. That's a noticeable downgrade from its previous projections. And the big reason, global inflation. The IMF expecting that prices this year will rise 6.6% in advanced economies and 9.5% in emerging market and developing economies. Here with more on that report is the IMF chief economist, Pierre-Olivier Gourinchas, joining us live on the program. Great to have you on the program. Just walk us through a little bit more exactly what the weight is of global inflation on the forecast, a noticeable downgrade from the last round of forecasts in April. How worried are you about global inflation tipping us into a global recession, perhaps?
Well, good morning. And you're right. I mean, pushing inflation has been one of the three factors we've highlighted behind the downward revision in our projection update. And the way inflation plays out here is that it's eroding purchasing power for consumers and households. And so that's leading to less demand. But it's also affecting their views on the outlook. It's creating uncertainty. It can increase their sense that maybe the future is less certain, is less secure. And it leads central banks, as we've seen the Fed doing in central banks around the world, really pretty much in every country maybe except China and Japan, to tighten monetary policy. And that tightening of monetary policy is also going to slow down economic activity. So that's one of the three main drivers of our revision.
So let's break down some of what we're seeing, where we're seeing that inflation come through from. Obviously, energy, a big one that we've been watching very closely. When you look at a place like Europe, there's still a lot of questions clouding the outlook there about what that supply is going to look like, both on oil as well as natural gas. How do you assess how significant a headwind that's likely to be as we look into next year?
Well, in the European context, this is where the second factor is playing out, and this is the impact, the continued impact of the Russian invasion of Ukraine and the impact it has on energy markets. And so we're revising down also our growth projections for the euro area, especially in 2023. In fact, in 2023, we are projecting that growth will slow down to about 1.2% for the euro area. But we're also flagging that there are important risks to the downside related to the supply of gas from Russia to the euro area. And if we were in a scenario where those Russian gas flows to Europe are fully shut down, then there would be another layer, if you want, in terms of the downward revision. And we're anticipating that it would knock off another roughly 0.8 percentage point of economic activity in the area. So this is sort of the second major factor that leads us to revise our projection is the slowdown we see in the euro area related to the impact of the war.
Well, as a follow-up, I want to ask about the central bank policies around all of these headwinds. When we talk about, for example, the European Central Bank hiking rates last week, the Federal Reserve having an important meeting tomorrow where they're also expected to raise interest rates, that's all supposed to get prices down. But as you just outlined, a lot of the price increases are due to something that's completely out of the central bank control, which is what's happening over in Eastern Europe. So do you worry about a central bank policy mistake here and hard landings, not just in the United States, but in other parts of the world as well?
Well, look, there are different sources behind the inflation numbers that we're seeing right now. And certainly, there are things related to energy and high oil prices and gas prices, for instance. But there are also, and supply chain disruptions, there are also demand factors. The fact that a lot of households came out from the pandemic with excess savings, what we call excess savings. They may not be seen as excess savings from the perspective of these households. So we have a combination of factors. But let's step back and think about where we were in terms of monetary policy back at the end of 2021. Conditions were extremely accommodating because central banks were trying to support their economies during the pandemic. And so it's only natural that at the very least we remove that level of support when we're moving away from the pandemic. And at the same time, we're facing these extremely high levels of inflation. So central banks have to tighten. They don't really have a choice at this point, regardless of where inflation is coming from. And we actually look at what a number of them are doing, and we think that this is more or less appropriate given the environment.
So they don't really have a choice here. Now, does that mean that emerging market central banks also don't have a choice here? We're seeing a strong dollar weighing around the world. I mean, this is raising perhaps some chatter of, could we see a 1994 like Mexican peso crisis? Could we see a 1997 like Asian financial crisis again, as some of these countries maybe have difficulty dealing with a devaluing currency domestically? Do you see that as an issue as well?
We certainly see a lot of financial tightening around the world, and it is having a serious effect on emerging markets. We see, as you mentioned, we see the strength of the US dollar. That's actually implying more inflation in a number of countries because they import goods that are invoiced in dollars, and so they see higher prices for these goods. It makes it harder to service dollar debt. We're seeing capital flow out of these countries, emerging market economies in particular, and we're seeing spreads increase. So all of this is adding to the pressure. At the same time, we are not seeing disorderly market conditions right now in the EM space. What we are seeing is a number of countries that have actually improved their policy framework, the way they conduct their monetary policy, the way they manage their exchange rate, let it adjust when conditions change, as we've seen, the way they try to use their instruments that they have at their disposal to protect their financial sector, to prevent a banking meltdown and the financial sector panic. And so far, we haven't seen really any disorderly response in financial markets. So I want to say, yes, there is tightening. Yes, there is pressure. But as of now, we are not seeing anything like the taper tantrum of 2013 or the Asian financial crisis or even the Mexican crisis of 94, 95.
Let's talk specifically about China. You're projecting growth of 3.3%. That is well off the 5.5% that the government had set for itself this year. Obviously, the zero COVID policy playing into some of that as well. But I wonder, when you look at some of the headwinds, the risk factors in China, what concerns you the most? And we've been also watching what's been playing out in the property markets really closely. It sort of feels like the government is reversing its policy to really double down on some of that debt they were trying to slim back on because of where the economy is right now.
Yes, there's been that's the third sort of factor leading to our downward revision is China. And, when you put it all together, the U.S., the euro area, and China, the three largest economies in the world, being revised down. This is what leads us to our gloomy outlook, if you want. But on China specifically, we are projecting 3.1% growth in 2022. And just as a point of reference, this is the lowest growth number since 1976 in China outside of the pandemic. So this is really something that is big news. And it's on the back of, as you pointed out, the COVID-19 outbreaks and lockdowns that we've seen in the first and second quarter, and also the slowdown in terms of the real estate sector. So looking forward, the good news about China is that it has a lot of policy space and it's not facing very strong inflation pressures. So it can remain more accommodating in terms of its policy stance. And in particular, fiscal policy can play a role to try to support the economy, and in particular, vulnerable households that might be suffering in the current environment. So we're seeing that there's room for China's sort of rebound in the second half of the year and in 2023.
And if we shift over to the United States, I mean, they had a pretty swift downgrade in this report compared to the April projections. Does that imply that you see a higher risk of a hard landing here in the United States?
Well, the way we would characterize it is that under our baseline projections, there is a narrower path. The growth is, as you show on your screen, is projected at 2.3% in 2022. Then we're expecting a slowdown on the back of this tightening of monetary policy and also in the context of still elevated inflation to about 1%. But the Q4 on Q4 growth in 2023 for the U.S. is estimated at about 0.6% in our projections. And 0.6% is a low number. It wouldn't take much of a downside, a materialization of a downside risk to sort of knock off the U.S. from having positive growth. So we're seeing a very narrow path going forward, not necessarily a recession under the baseline, but certainly a very vulnerable situation.
Certainly a lot of layers to all of this. IMF Chief Economist Pierre-Olivier Gourinchas, it's good to have your time today. Appreciate you stopping by. Well, let's take a look at one trending ticker we have been following today.
I want to welcome everybody to another very special Yahoo Finance Plus webinar. We have Liz Young, Head of Investment Strategy over at SoFi. She's going to join us in a minute here. And the title of this webinar is Fighting the 2022 Bear Market as the Fed Fights Inflation. We got some interesting thoughts on that. Just want to do a little housekeeping work here. We're going to do some polls. We're going to do one in about 30 seconds here. You can ask questions. We will try to get to as many as possible. We really encourage that. We want this to be interactive. We want this to be educational and fun for you. So let's start off with a poll here. Poll number 2 is, and let me get to my notes. Do you think the bottom in stocks is in? That's the first poll. So you bet I'm all in. The new bull market is underway. Not sure, but waiting in. Not sure and staying in cash. Or are you kidding? We are in a bear market. So let's welcome Liz into the stream here. Liz, really appreciate you stopping by. And we had an interesting conversation earlier today. And the title of this webinar, Fighting the Bear, all right? Maybe it's not a bear because every bear market ends and every bull market begins with a low. So are we there now?
Well, technically, we're not anymore, I suppose, because a bear market is beyond 20% down. I think we are out of that. However, I think there are a lot of people out there who have wanted to jump on the bull bandwagon and say it's all over, everything's fine. We had that really big rally earlier in the week. Unfortunately, I don't think it's quite over yet. And the reason I say that is because there is still a lot of data that we have to get through. And that data is going to be data about earnings. It's going to be data about the economy. And in order to really feel confident that we have bottomed and the worst is behind us, we need both of those things to come down to probably a more reasonable level, given where we are with inflation and given the trajectory of what the Federal Reserve intends to do.
All right, I want to follow up on that in a second, but let me just get to the poll results. Well, it looks like we're still trickling in here. So let me just follow up on your definition of a bear market. There are a lot of different opinions out there. Traders tend to look at things differently than economists. And then you have the 20% down rule, which you just said. What is a bear market to you and what is a bull?
Well, so a bear market, I mean, I do use that definition. You have to get beyond 20%. And the reason why I think that's important is because with all of the electronic trading that goes on, there are triggers at certain levels. And that 20% level is certainly a trigger. But here's the other reason it's important. Because once we start approaching it, and this time was interesting because we approached that 20% level and we didn't come down off of it for a while, or I'm sorry, we didn't cross over into 20% for a while. So we kind of chopped around right around it. However, once you get there, that's when the market has to decide, do we deserve to be in a bear market? And how bad does it have to get? And here's what I would say. On average, when you have a bear market, and I'm defining it as 20%, when you have a bear market without a recession, on average, the drawdown has been 28%. When you have a bear market with a recession, on average, the drawdown has been more than 40%. So we're in that weird in-between phase where the market's trying to decide, okay, is this a recession bear or is this just a bear? In which case, maybe we went down far enough. But we're not going to know whether or not this is a recession bear until at least next week and probably even further into the year.
That's right. And the official recession, and you mentioned the R word, the official recession is called by the National Bureau of Economic, NBER, and they were so late to the game in 2008, 2009. I don't think we knew the bear or the recession was officially over for another year there. Let me get to the results of this poll. You bet I'm all in, only 5%, 1 out of 21. Not sure, but waiting in, that was 67%. Not sure, staying in cash, almost 20%. And are you kidding? We are in a bear market. That's 10%. All right, so we got that. I want to pull up, I want to go to another poll first, and then maybe we can get back in and answer some questions. Poll number 1, or this is in my numbering. When did you start investing trading? Is it less than a year, 1 to 2 years, 3 to 5 years, 5 to 10, or 10 plus? And I see things rolling in here. We got some veterans, we got some newbies, and we always like to see a good mix. So Liz, I'm going to field one of the questions from that was submitted when people registered for this event, and it has to do with 60-40. This comes from Dan Long. Are bonds going to be an attractive option once the Fed gets through a Fed rate hike? And do you see a 60-40 model portfolio, I guess, doing well because it's been terrible this year so far?
So I actually think bonds are an okay option right now. And I think I started talking about them a couple months ago as yields rose and we saw a sell-off in bonds that we haven't seen in many, many years. That's coming on the heels of what you've heard many times, a 40-year bull market in bonds, which is very uncharacteristic of that asset class. But I think right now, because there is recession fear in the air, and because I think we're getting to the point where the Fed is going to have to say, okay, you know what, it's working, things are coming down, inflation is slowly making its way down. I don't know that yields are going that much higher from here. So I think it's okay to be entering bonds here if you haven't had bonds in your portfolio. And always remember, when you're constructing your portfolio, it's a 3-legged stool, okay? The first leg of that stool is preservation. The second leg might be income, if that's something you're focused on. And then the third leg is growth. And you have to decide which one of those is most important to you, and then rank them in order. And that's how the assets that you put in your portfolio should reflect. So if you're worried about preserving capital, in this environment, I do think that bonds can work if recession fears continue to get worse and worse, because that's a time when you see things like the 10-year yield rally, you see people flow back into really high quality securities. Bonds are one of those.
All right, I just pulled up a long-term chart of the 10-year Treasury note yield. Ties into what you're talking about, yield moving inversely to price, but you can see we are in a very long down channel, downtrend, and we are just poking above these levels here. And this was a very fast and furious move. I'm just wondering, do you think about, and this is very long-term, what it means when rates finally break this big downtrend and they trend upwards again, or at least sideways at a higher level?
Well, it means a couple things. I mean, this happened because inflation hasn't been where it is today in 40 years. And it was clear that it wasn't just a US phenomenon, it was a global phenomenon. And everybody around the globe is fighting inflation, which then means that central banks have to react. And almost every central bank has a stated mandate that says they have to try, at least, to keep prices stable. So this is something that is reflecting the idea that central banks were going to raise rates, which is exactly what we're in the middle of right now. The ECB raised rates by 50 basis points today. Canada was 100 basis points last week. So we're obviously in a cycle where central banks are trying to fight inflation. Now, the spike up in yields was a reaction to that idea. And remember, the Fed just started doing this in March of this year. I know it feels like it's been happening for a lot longer than that. Really, we have not been in this hiking cycle for very long. The next level that's going to be interesting is when the Fed funds rate, starts to approach the yield on the 10-year Treasury. That tends to be a time where the market gets a little uncomfortable, because if the Fed raises the rate markedly above the 10-year yield, that usually is not something that markets welcome, that usually causes volatility in the stock market. Right now, we're not there yet. We've got a Fed funds rate that's an upper bound of 175, but next week could very quickly take that upper bound to 2.5. So when you have a Treasury that's hovering around, let's say 2.93%, if we go up another 75 basis points from the Fed next week, we're in the ballpark where the Fed funds rate is right around that 10-year Treasury rate. And then the September meeting will be the one where, if it stayed steady, the Fed funds rate might go above the 10-year Treasury rate. So I think after next week's meeting, this is going to be a really interesting stock bond mix to watch.
Yeah, and let me just ask you about the dollar here, because that kind of ties into rates. And I'm going to, let me see if I can share a chart of the Dixie. Now, this is a US dollar index. It's heavily weighted to Europe, Euro, and also the pound. But this goes back to, let's see, 2017. I'm going to put some more history in here. We haven't seen levels in this area since way back in 2002. So we're talking about 20 years, another 2-decade-er, as you've been noting in your Twitter feed here. The dollar puts a lot of headwinds on a lot of different markets. Just wondering what your thoughts on the dollar are. Is the move like the move, is the move, I guess, done for now? And what do you think if the dollar heads higher?
I don't know that it's going to get that much higher. It could, but I will say so always remember, currency is a relative game, right? So this particular index looks like an absolute index, but it's always a relative game, meaning it's this currency compared to that currency. So it's always the strength compared to another currency. It could go higher from here. And here's the thing, a strong dollar is usually a headwind to multinational corporations because they get a lot of their international revenue. Sometimes the mix can be 60-40 even. So when you look at a lot of corporations getting international revenue, the dollar is usually a headwind to that. It's also been a headwind to GDP this year. So if you look at what happened in the first quarter, we had a negative GDP print because trade was a drag. Well, trade was a drag for a couple different reasons, but one of them that was a big reason was a strong dollar. How does that happen? I want to make sure people understand this. When the dollar is strong, first of all, when we export goods, that's positive for our economy. When we import goods, it counts as a negative for our economy. When the dollar is strong, our exports are more expensive to other countries, so they buy less of them. We were importing much more than we were exporting in the first quarter, which is why trade became such a drag on the GDP number. The dollar has stayed strong, so it's probably going to be another drag, maybe not as big of a drag, but it's still a drag. It's also, again, a headwind for those multinational corporations. Now, the question was, do we think it is going to keep going up? Do we think it falls from here? I think it at least stays strong. I don't know how much further it could go up. The reason I think it at least stays strong is because even though we have our own set of problems in the United States, we are still stronger as an economy than a lot of other nations around the globe, in which case you see capital flow here more than you see it flow towards something like Europe, for example. So I think the dollar strength is here for a while.
Right. I want to get to the results of our last poll. That's when did you start investing trading? One person said less than a year, 13% said 1 to 2 years, and also 13% 2 to 5, 5 to 10, 22%, 10% or 10 years plus, almost 50% there. And we're going, yes, we got some veterans in the room. We're going to go to poll number 4 here. What is the best recession indicator forecaster? Is it U.S. Treasury 2-year 10-year spread? Is it 2 months of negative GDP, U.S. Treasury 3-month 10-year spread, or life is a box of chocolates? You never know what you're going to get. We'll keep that up for a minute. And I want to get to another question here from the audience. And again, we highly encourage you to submit your questions here so that we can take them in real time. Do you think tech stocks will regain the amount of losses it has lost recently? For example, Upstart, Aura. I think this is a question a lot of investors have because we've seen some of these stocks like Peloton get cut 90%. And I like to remind people that a stock goes down 90%, has to go up 900% in order to get back to break even. That takes a while, and a lot of times it doesn't ever happen. Your thoughts on this, Liz?
Yeah, so I can't talk about individual securities. Sure. I have a feeling somebody wanted to ask me about SoFi, but I cannot talk about that. So here's what I would say. There has been a lot of what I would call multiple contraction in those tech stocks. Now, if you're asking, do I think the entire tech sector can get back to where it was? No, at least not anytime soon, because the reality is that we're still in a situation with high inflation and with tighter monetary policy, which means higher discount rates. And a lot of what allowed tech stocks to get to that level before was a function of having really low discount rates. So as long as those rates stay high, we have a headwind for tech, or at least a sort of a ceiling on those high growth stocks. Now, what I talked about a little bit before, the 10-year could still come down from here if there's recession fear in the economy. That is a tailwind typically for those growth stocks. So you're seeing, I think today still, I haven't checked it in the last 45 minutes or so, but the NASDAQ has been doing better than the other two indices because the 10-year yield had come down. So if the 10-year continues to come down, or rates overall continue to come down, you should see strength in the NASDAQ relative to some of the other indices that aren't quite as tech heavy.
All right, we got the results of the poll. The U.S. So the question was, what's the best recession indicator forecaster? Is it the 2-year 10-year spread? 30% said that. 2 months of negative GDP, that's 30%. U.S. Treasury 3 months 10-year spread, about 25%. And life is a box of chocolates. Reference to Forrest Gump, excuse me for the noise, 30%. So we talked about this a little bit before, and I think we covered that fairly well. I want to do a thought experiment here. What we were talking about at the, well, we talked about this earlier. People have been waiting for the Fed to pivot. I say they're waiting for the Fed to blink, and I think you kind of agree with maybe with that terminology or a different word. But we're not going to get any big movement or from the Fed anytime soon because we need more CPI prints to come in. We need more economic data, and we just need a lot more in general. I'm just wondering what your thoughts are when the Fed eventually starts to take off the brakes.
So I want to talk about the poll first, too.
Okay.
The recession indicator. So 2 consecutive quarters of negative GDP confirms a recession, but it doesn't forecast one, right? And when you look at how do you forecast a recession, now the yield curve, the 2s, 10s yield spread is a decent forecaster. But the problem is defining what really counts as an inversion is a different answer depending on who you ask. I think, earlier in the year, we had a brief and shallow inversion, and then we had another one that was like a whisker of an inversion. Now, this one is a little bit more notable. So we're inverted by over 20 basis points. It's lasted a couple of weeks. That's probably more like a true inversion. However, I think actually a better forecaster or indicator to watch is what's called the near-term forward spread. And what that is, and this is a little complicated, but what that is the current 3-month Treasury yield compared to the expectation of the 3-month Treasury yield in 18 months. Okay, so why does that matter? It matters because what it's supposed to indicate is when the Fed will have to cut rates. So if the 3-month yield in 18 months is lower than it is today, that would indicate that sometime between now and 18 months from now, the Fed had to cut rates, likely because of a recession or some sort of really bad softening in economic data. That spread is not inverted at this point. It's tight, but it's not inverted. And it's tightened by 200 basis points since April, but it's not inverted yet. But I would keep an eye on that. As far as, what happens in the recession, and I'm forgetting the rest of the question. What was the rest of the thought experiment?
So what happens? What do you need to see from the Fed in order to say, they're pivoting now, or they're blinking now?
Yeah. Okay. Also, let's define what the word pivot means. To me, a pivot means that they start moving in the other direction, right? I don't know anybody if you've played basketball, when you pivot, you change direction.
Yes.
My dad was a basketball coach for 36 years, so I've done a lot of pivoting. But when you pivot, you change directions, right? So to me, a pivot is when they stop hiking, whether that's a pause or a cut. That's a pivot. They could perhaps reduce the size of the hike. I don't see that as a pivot. I see that as a slowing in their policy tightening, right? Right now, the market is expecting them to reduce the size of their hikes in September. So it's expecting 75 basis points next week, 50 basis points in September. I don't think that's a pivot, but I do think that would be met by perhaps some positivity in the market, only if it's coupled by 3 consecutive months of inflation, month-over-month inflation coming down, right? So that, unfortunately, we won't have possibly until October. So if you think about, we're going to get the July data, that could be the first month, and then the August data, and then the September data, that would be 3 months in a row, but we won't find out about the September data until October. So there's some time before we're going to say, okay, you know what? They stopped hiking by as much, and they did it because inflation is coming down. It's working. If, on the other hand, they stop hiking by as much because the economy has gotten notably worse, that may not be met by such positivity in the market, right? That would scare the market. If we know that they're slowing down because they say something like, you know what, labor market, we're not feeling as comfortable anymore, so we're going to slow this down. It's all about the messaging.
Got it. We're going to shift gears here. I think we got poll 6. Let's do that one next. What is the most important part of investing or trading for you? There's no wrong answers here. Just kind of feeling you out. Risk management, having a trading plan, cash preservation, the Fed is in print mode, or I'm a fly by the seat of my pants kind of investor. We'll get to that in a second. So here's my pivot. We want to talk about oil. We talked about the dollar, and this kind of relates to that. What is going on with oil? By Tristan. What's going on with oil?
What isn't going on with oil is kind of how I feel right now. I guess I'll start with the punchline. I am not somebody who's a big energy bull right now, not because I don't think it's going to stay high. I do think that prices will stay elevated unless we go into a recession. But it's because I think we saw the big spike already. And now we're sort of in this range where we're waiting to find out whether or not there's going to be a demand destruction or a lowering of demand, which would affect the price of oil. And because it's so affected by some things that are completely out of our control and completely difficult to forecast and foresee, such as a war between Russia and Ukraine, and any statement that comes out of the Middle East or OPEC about the supply of oil, or who knows what'll come out of the war in Russia and Ukraine. That could de-escalate tomorrow for all we know, right? So the thing about oil and a lot of commodities, especially the ones that are so affected by supply and demand, is that the chart, when you look at it after a little while, when it changes direction, it can look like blunt force trauma. And you as an investor cannot catch that on that downtrend. It just happens so fast that you can't possibly catch it and protect yourself. So for me, in this environment, because I think we're getting to a point where you can wade back in to some of the sectors that you like and some of the asset classes that you like, and I think you're going to get a lower chance to do it. The energy sector is not a place that I'm willing to put a ton of my capital in and say, okay, I hope it works out. I think there's just too much risk and it's not worth it at this point.
I think it's worth remembering that WTI all-time high was just short of $150 in 2007, 2008. And towards the end of 2008 into early 2009, it crashed down to $30 a barrel while the Fed was cutting interest rates. So I want to get to the results of our last poll. What's the most important part of trading for you? Risk management and having a trading plan were the two biggest answers. Each got 47%. I'm happy because I've asked this before. And the answers were different. Cash preservation, 5%. Fed in print mode, nobody. I'm a fly by the seat of my pants kind of investor. 2 of you said that. Let's talk about having a trading plan and risk management and the investors watching their own backs right now, because most people have had a drubbing this year, Liz.
Yeah. Okay, here's what I would say. Look, if you're a fly by the seat of your pants investor, you probably get it right almost as often as people who have planned it really well. Here's the point of planning. The point of planning is to try to remove the emotion from the equation. And if you have a solid plan in place, for example, if you have a plan, let's say for the next 60 days that you want to start averaging back into the market, that plan might look something like, okay, I've got this chunk of money, let's call it $1,000 just to keep it easy. I've got $1,000. I want to put it into the market by the end of September, right? That's plan number one. Then the next plan is I'm going to do that by investing about $100 every Monday until it's gone, right? That's an okay plan, because then you don't have to try to figure out, oh gosh, should I wait until tomorrow? Should I do it today? There's bad news on whatever stock. Should I wait until it goes down further? Because then you're second guessing yourself. You're letting emotion get in the way, and you're trying not to make any mistakes at all, when in reality, we're all going to make mistakes, and you probably can't call the bottom on every single stock and every single thing that you're doing, and certainly not on the market as a whole. So planning and risk management takes that emotional piece out of it. When you're making investing decisions based on that sort of FOMO or excessive fear, you're likely to make more mistakes. Now, fly by the seat of my pants, I think sometimes it's okay from a timing perspective, to be frank, because nobody can predict it. The only thing I would say is make sure that you're still diversifying your portfolio. So you could be fly by the seat of your pants and really, really like tech stocks because that's what you work in and that's what you're familiar with, and you just like the names, you use all the products. I totally get that. But make sure that you have exposure to other things that might sound maybe a little boring to you, that might sound like, something that only old people would buy. I don't know. Whatever the case may be,
NFTs, yeah.
Make sure that you are diversifying it still.
Great. Here's a question from Joshua West. It's related. What education would you prioritize a novice seeking preparation of the forecasted market? So education, really big. I like your answer just now. So go for it, please.
I'm assuming we mean education of if you're an investor right now and you're kind of learning as you go. We're not talking about going back to school and getting a degree. I would recommend, the only real way to learn is by doing, but I would also recommend on a daily basis, especially in earnings season, this is really important. Watch the reports of companies that you understand and try to figure out what's under the surface of them. So let's say a company missed on earnings. Why did they miss? Why did they say that they missed? Did they have an inventory problem, for example? Okay. And I'm just trying to take you through an example so that you understand how the education piece goes. So let's take, I won't say specific names. Let's take a large retailer that perhaps would have reported last quarter that they had an inventory issue. Okay. And that inventory issue was a drag on their earnings. I would go back and listen to why that inventory issue occurred. You would find out that the inventory issue occurred because they miscalculated what the consumer was going to buy. How did they miscalculate it? They miscalculated it because the consumer changed their mind, right? So what happened was consumers started to spend money on other stuff. And here's what happens. Then you get kind of down this rabbit hole. Okay, Then you start looking into consumer spending. And a lot of this data is absolutely publicly available. You can find consumer spending data on the Bureau of Labor Statistics. You can find it on the Bureau of Economic Analysis. All of this is publicly available on the internet. You can download the data yourself, the whole thing. Then you start to dig into, okay, how did consumer spending change? And what I would say about educating yourself is try to take the thought all the way through and figure out at the end, all right, what was the macro environment over that period? How did it affect the corporation? And that's what you find out from earnings. And then last, how did the market react to it? And that's a good formula. So you take macro, corporation, market. That's how you start to understand how the market reacts in different scenarios, why the market reacts in different scenarios. And you'll feel like the next time something happens or you get a bit of news that's a surprise, you'll feel a little better prepared to either trade on it or not trade on it, right? Or figure out maybe what the opportunity is that it presents tomorrow.
Liz, that's really great advice. When are you writing your first book or next book? I couldn't find any on Amazon.
I don't have time right now,
Neither do I.
but someday, it's on the bucket list to write a book.
Yeah, that was clever because there were two of those that happened in one day, and those were huge surprises that you just don't see. Let's stick with earnings. Actually, we got to do poll 3, if we can pull that up. I think the greatest risk to stocks right now is what? Recession, Fed fighting inflation, strong U.S. dollar, Russia, Ukraine, COVID lockdowns. Obviously, no correct answer here. But I want to follow up on earnings. We chatted about this too. A lot of people saying, a lot of analysts saying, well, the EPS estimates, those haven't come down yet, and we're in the thick of it, or we're getting into the thick of it. What are you seeing, and what are you expecting?
Yeah, so the rubber really hits the road next week. Next week alone, I think there's 168 S&P components reporting. It's more than 33% of the entire index. So by the end of next week, we're going to have a really good gauge of where earnings are this season. So far, companies are still beating. Now, look, they always beat, right? Unless we're in the middle of some kind of earnings contraction, companies usually beat. That's just how this works. I don't know why, but they're beating by about 4%. So we call it a surprise, right? So positive surprise is about 4%. I don't know. I don't have that factored in for whatever's happened today, but 4%. On average, that number is about 9% or 10%. Okay. So we're still beating, but beating by a lower percent than average. What I think we might hear next week, and these are companies across a lot of different sectors. We're going to hear from a number of consumer companies. We're going to hear from transportation companies. And what I mean by that, like UPS, right? We're going to hear from companies like that. We'll hear from some industrials, some materials companies, tech companies, and the ones that are goods sensitive, meaning the ones that make stuff, the ones that make widgets and sell it to people, are the ones where you're probably going to hear about inflation having squeezed their profit margins and that they had to absorb it instead of pass it all along to customers. And we're going to hear everybody's outlook for the rest of the year and maybe into 2023. So if earnings are going to come down, if earnings estimates are going to come down, they're going to really start coming down next week and then the week after. So that's definitely something to watch. It's another reason why I keep saying, let's wait through the end of July, because we've got so much happening next week. It could be a real whipsaw week. We've got so many earnings, we've got a Fed meeting, and we've got GDP.
Let's go over the results to this poll. Greatest risk to stocks right now, recession got the biggest percentage, that's 50%, half of you. Fed fighting inflation, 22%, strong US dollar, 6%, Russia, Ukraine, 17%, and COVID lockdowns, 6%. So recession still top of mind here. I want to remind you guys, ask questions, and thank you for the compliment. This is why, guy. If you got a question for us, we'll be happy to take it here. And speaking of questions, let's get to one right now. This kind of gets back to what we were talking about, investor education. Let's see. I'm sorry, I lost my place here. As someone who is learning to invest in turbulent times, I would like to know what tips you have for learning and improvement. That is by Vinayaka Thompson. Liz.
Well, I mean, look, I say this a lot to younger investors, especially. The first bear market you go through as an investor will shape you for the rest of your investing life. Now, it doesn't mean that you can never change your mind, that you can't learn more, but it will shape you and you'll remember it. You'll remember how much you lost. You'll remember what caused it. You'll know what the environment was. The only real way to learn through that is to keep doing it. I think the worst thing you can do is pull all your money out, put it under the mattress and say, I'm not doing it again until everything is better. Because if you look at a long-term chart of the S&P and you look at even just 10-year periods, there is not a 10-year period where it goes down. Maybe it's flat. The worst that's happened, I think, is that it's been flat, but generally speaking, it still goes up. So over the long term, still goes up. That said, you can read books. There are a lot of good investing books out there. It's going to depend on what you're into and how deep you really want to dig. There are a lot of really classic ones out there. So I would do some searches on maybe the classic investing books. I'm thinking of things like The Intelligent Investor, right? Things like that. But some of those are pretty deep, pretty granular, and could be too much for somebody who's doing this more for sport than really trying to do it academically. But you can also look at books like The Psychology of Money, right? Things that are talking about behavioral investing and what that really means. You can look at books by different financial advisors and really how they think about constructing a portfolio, how they think about a timeline. And again, you have to do this every day. You have to be looking at it consistently. You have to be reading the news. You have to be understanding how the news has affected the market. And over time, it starts to really click. So it is something that's a discipline. It is something that you have to just continue exposing yourself to.
I think that's great. I'll add a little bit here. Trading is a business, and I think people should treat it as one if you're not a passive investor, because the competition is hedge funds with billions of dollars, and they have processes like you wouldn't even believe, not you, Liz, but most people wouldn't believe how much they scour and their trading books, how they review their theses every single day. There's a reason that they don't sleep. Also, you also mentioned that the first bear market shapes you, and the bear market, the last bear market before this was a COVID one, but it was so quick that most people blinked and it was kind of over. We didn't have new investors. The stimmy checks weren't going out yet, so for a lot of people, for a lot of the new people, this is their first one. But going back to that COVID bear market, what do you think about that? The fastest one in history, and I think the fastest bull in history as well, getting back to new all-time highs.
Well, the way we go into it matters. And that bear market was caused by such an abrupt shock. And what we saw, the response that we saw from fiscal and monetary authorities was just as abrupt, right? It was just as fast. There was immediate and emergency rate cuts. I mean, we had 4 days, and this is just a side story, but I was actually at the New York Stock Exchange. I think it was the 3rd time that we hit the circuit breaker down.
I was there that morning.
This happened last March, and it was the 3rd time that we hit circuit breaker down. And I'll tell you, it was eerie. I will never forget that. I will never forget when that bell rang and the market closed and we halted trading because we had gone down too far. That was a very abrupt, very dramatic spike and stab down, right? And that was a time when we bounced back out of it from a market perspective, but we did not bounce back out necessarily from an economic perspective. Those lockdowns lasted much longer than I think any of us expected. And when we came out of them, then we had an inflation problem, right? We had a supply chain problem. So I would argue, yes, the market reaction was quick, but the economic recovery that occurred afterwards has been a little bumpy. And I think, for people that are experiencing this as their first bear market, it's probably felt really long too, because we've sort of grinded lower over the last 6 to 8 months, depending on what index you're looking at. The NASDAQ started grinding lower last November. So it feels like this has lasted forever, but realistically, bear markets do tend to last longer than, a week and a half. So you will remember this. And when you go through your next one, maybe it won't seem so bad, or maybe you can set your expectations better. I think the hardest part of being a new investor and a new bear market investor is to not know when it might be over and not know what's normal, so to speak.
Couldn't have put it better myself. It's time for me to do a little show here on Yahoo Finance Plus. You guys are all members. Some of you might have gotten the free trial, so apologies if I go over something too basic for you. But here is our dashboard. Welcome, Jared. And I put in a little watch list. This was a few years ago. You can see underperforming the market by quite a bit. probably because it's not diversified. If you take a look right here, diversification, 51% of the stocks are exposed to the others sector. And if we click through here, we can see some interesting stats and helpful things at the top of the screen. Here's the annual performance, little squid graph there. Risk profile, moderately aggressive. Valuation, based on the Peter Lynch model, 6 are overvalued. So you can see maybe you're taking on a little bit too much risk. And then we have diversity, 36, what is that? 30.6% in the communication services. Sounds like a little bit much for this market. And let's take a look down here, because this is going to show you where your portfolio is allocated. And I think I've showed this before. I'm going to skip over to let's see if we can get community insights. So this is one of the features that has been added, I believe, over the last year, and it keeps getting better. This is based on proprietary Yahoo Finance data of people visiting our ticker pages. That's where we get the trending tickers info that's free on our site, but this goes into a lot more detail. And as you know, you can upload your portfolio to Yahoo Finance, and we aggregate the data and we show you what people are buying and selling. So here we have the most visited companies, and we have Netflix in there, IBM. This is going to be full of earnings names, especially when we're doing those big names in earnings season like we are. And this is helpful as too. You can see what sectors are on the move, or at least top of mind for investors: communication services, which I'm overweight in, apparently consumer defensive, financial services, etc. And then you have community conversations. Here's one with DD Global. You can click through on here. But portfolio changes, that's what I just talked about. This is very helpful information just to get a sense of what people are buying and selling. One of the first things I do in the morning, because it's part of my job, is look at this to figure out what people are interested in, so I can plan my day, which is a little bit different from the average investors. But having said that, let me move on to research reports. This is another one of my favorite areas. This, you're going to be able to get reports on all the companies that are reporting. You'll get analysis after the fact. So here's one on Amazon.com. You can see this is after their 20-for-1 stock split. It's going to give you all kinds of information. You can download the report. I'm not going to go through it right now. And then finally here, I want to take people through the investment ideas. Let's see if I can get that up. And here we go. So we have investment ideas that are sent throughout the day. And some of them are based on fundamental analysis. Some of them are based on technicals. So here's one on JB Hunt, Schwab, Netflix. Let's click through to Netflix. And you can see Netflix has a bullish trend. And this is a summary of the, let's see if we can get this in a chart. There we go. This is going to tell you on the technicals exactly what's happening. Let me change this from a 1 month to a 1 day and see if we can get this annotated. You'll have to forgive my user operator error here as I'm trying to talk at the same time. So I guess I messed that up, but let's get back there to research reports, investment ideas. And has it been a long day yet?
It's been a long year.
Thank you, Liz. Thanks for your support here.
I'm here for you.
I appreciate that. Idea type. Let's get to some of the fundamental ones. Boom. So all these are the fundamental ones. And then let's get to the technical ones. For instance, here's one. TGNA forms a continuation diamond wedge pattern, which is bullish. We want to see this in the chart, and it will draw it for you. Right there, it'll give you a little explanation, what it means, an event description, and these are automatically generated. So these aren't necessarily going to be picture perfect, but this is a starting point for some ideas. Now, I want to get to we got to that result. And here's a question from somebody anonymous. If I'm down 35 to 40% on said retailer who has inventory issues and a significant part of my portfolio, we flip a coin here, figure this one out. Would you suggest selling and moving on to one higher potential ROE trades, or wait, knowing I bought it at an expensive price? And your thoughts, Liz?
Okay, well, yeah, retailer who shall not be mentioned. Again, this is absolutely not specific stock advice. Here are two options I'll give you. There's a thing called tax loss harvesting. You could do that if you have some tax gains. I don't know how many people have gains this year, but yes, if you have some gains that you'd like to offset, you can do something like that. You could sell something that's down in a certain space and buy something that you think replaces it more or less. and still participate in upside that would happen, or you can replace it with something like a retail ETF, right? But what I would actually say is that we're already seeing some nice optimism in the consumer discretionary names. The two names that we're talking about really were in the staples category, but just in the consumer category overall, what could happen is that if fear really peaks and we find out, you know what, we're going into a recession or we're in one and it's going to get worse, what we probably start to hear in earnings season, especially from consumer discretionary, is them guide down, and the market does have to wade through that. So it could go down further. So unfortunately, you're down 35%, maybe it goes down more, but that also then is likely a good opportunity and a good entry point. So I would say I wouldn't lock in all your losses because you can't get those back once you sell out of it. And really think about if you can take advantage of tax loss harvesting, and that's something that you want to do maybe a little bit, but I wouldn't lock it all in as a loss right now.
And yeah, great stuff. And I would add too that a lot of people, there are people who are down 90% in some of their stocks. And if you keep that in your portfolio, you're going to be looking at that for a long time, and it can weigh on you psychologically. And I think that's an important thing to remember. Citigroup is still down 90% from its 2008 high. It's down 90%, just writing about it earlier this morning. We got a little bit of time here. So final question, did you ever play basketball?
I went to a lot of basketball camps when my dad was a coach. I spent a lot of summers at basketball camps. I did actually play for a very brief period when I was a lot younger, sprained my ankle once and said I never wanted to do it again. But I did play softball for my entire childhood up through high school. That was a deal I made with my dad. I wouldn't play basketball, but I would play softball.
All right, that was not the last question. I'm going to give you the field here. Anything you want to add? We got a couple minutes for our viewers as we wrap the session.
Yeah, look, here's what I would say. Sentiment is shifting on a dime right now, and we're still in a period where you could make a decision, make a trade on a Tuesday and feel wrong by midday on Wednesday. That is not an environment where you want to be incredibly active, in my opinion, because you're going to continue to chase your tail in a lot of different things, and it gets really stressful. So again, I want to wait until we're past next week. I want that other data to come in, and I want to give the market a chance to react to it. It's possible that the market likes everything that happens next week, but I am okay with missing the beginning of a rally for a little while, because what we really need to do as investors is avoid those huge, steep drawdowns, because those are the ones that we've talked about a couple times on this show. Those are the ones that take a lot longer to claw your way out of. So I'm okay with missing a little bit on the upside if it prevents me from having an entirely large drawdown in a really quick time frame.
Liz, really looking forward to that book that you don't have time to write right now, but when you do,
we need a ghostwriter. Anybody here a ghostwriter?
Do we have a poll for that? No, we don't.
Yeah.
We are finally out of time here, but it was a pleasure spending this time with you. I hope everybody learned something. Liz Young, SoFi Head of Investment Strategy. And a big thank you to everybody who came here today, participating in our polls and submitting questions as well. We're going to see everyone back in about 1 month. Thanks again.
To the closing bell on this Thursday, July 21st. And we are getting that closing bell right now. You can see in the New York Stock Exchange, I believe it's Core & Main, a company that distributes water, sewer, storm drain, and fire protection down in Wall Street, guys.
That was the closing bell on Wall Street. Stocks looks like we're holding on to gains. The Dow closing up 162 points. S&P up just about 1%, just shy of that 4,000 mark. NASDAQ, the leader once again today. That's been the story all week, with the NASDAQ closing up just about 1.3%. Taking a look at the sector action today, consumer discretionary, healthcare, materials, technology among the leaders, communication services, energy to the downside, with energy off just about 2%. Well, for more on this, we want to bring in Kevin Mon, Hennian and Walsh Chief Investment Officer. And joining us from Boston, we have Ryan Bellinger. He's Claro Advisors founder and managing principal. Kevin, first to you, because it's about the third or fourth day in a row where we've seen technology lead, NASDAQ outperforming. What do you make of the buying action that we're seeing in the leadership from some of those large cap names that have been beaten down so far this year.
If you think about it, the names that have been hurt the most during this pullback in 2022 have been technology, consumer discretionary, notably e-commerce. Boy, did we get an announcement from a big e-commerce name this morning with Amazon's acquisition, spending $3.9 billion now to get into the healthcare space. I'm not going to call the bottom here, but what I will suggest is that if, in fact, we've met the technical definition of recession, and I believe that we have, and recessions last on average 12 months, well, guess what? Typically, the stock market bottoms about 4 to 6 months prior to the end of a recession, which puts us right into that August-September timeframe, which is when I think the Fed will turn less aggressive, and that should provide upside potential for stocks as well, including technology stocks.
And Ryan, do you also believe that we're in a recession? And if so, how are you positioning your portfolio? What are you rotating in or out of?
Yeah, certainly possible that we're in a recession. It's just hard to know. Oftentimes you look back and have those answers. But yeah, from the leading indicators that we look at, certainly a few of those are turning negative with manufacturing and new orders. Consumer sentiment's a big one for us. I mean, it kind of is self-perpetuating. Once people start to think we're in a recession, you kind of start to be in one. And so just to be defensive in portfolios, we're liking the dividend-paying stocks, companies that are providing a tremendous amount of free cash flow. But we also are not abandoning the large-cap technology space. I totally agree. I feel like there's some really good opportunities for investors with a longer-term time frame to pick up some companies at great prices, companies that people liked in the last couple of years, and they're still making good products and have great technology. So just because the share price is down, that's actually the reason to buy. And so that's what we're telling our clients.
Kevin, what are you seeing from the consumer? We've talked about this self-fulfilling prophecy, so much talk about being in a recession or whether one's lying down the road.
Yes.
Are we talking ourselves into a recession?
Well, there's a couple of traditional indicators that are flashing red, right? The yield curve is inverted right now. The yield curve has inverted before every recession in our country going back to 1955. And we also know that in all likelihood, we've now had 2 consecutive negative quarters of real GDP. But to your point, we also see the consumer still spending. We have an unemployment rate at 3.6%, and retail sales still feels relatively strong. But there are dents in those armor as well. We saw initial jobless claims today. The 4th consecutive weekly uptick, over 251,000. Our personal savings rate has now dipped to 4.4%, and Americans are putting more on their credit cards than they ever have before. They're still spending, but they have to borrow from their savings, put it on credit cards to keep up with these inflated prices. How much longer can that last? And if they pull back on spending, well, 70% of our economic growth comes from consumers.
Yeah, John Stankey this morning said that he's seeing people pay a little bit later their bills each and every month, and that's why he expects a little bit of a waning economy down the road, just seeing little slippage here and there.
Yes.
Yeah, Ryan, we heard Kevin saying that he expects maybe the Fed won't be as aggressive as some on the street are anticipating, that we'll see at least into the fall. Do you agree with that?
I think it's going to have to depend on the CPI prints. I mean, if these things keep coming in really hot, they don't really have a choice. I mean, this is their principal mandate at this point. They've got to get the inflation under control. And statistically, they have to get the Fed funds rate at a level above future consensus inflation rates. So if we're going to settle in at 4% or so, I really feel like we got to get there on the federal funds rate. It's a little higher than the forecast is now. Certainly the data can change, but it feels to me like the Fed has got one clear goal. That's to stamp out inflation by raising interest rates. And so that's what we're thinking is probably going to happen.
And Kevin, obviously, with every data point that we get in, we see the market sort of fluctuate, but they do seem to be pricing in that 75 basis point hike. What are you doing? What are you concentrating on to really not focus on the noise, but really focus on what's going to give you a clear indication of where the markets could be headed in the next few months?
Sure. And I do believe that the Fed will raise rates by 75 basis points next week. They don't meet in August. They come back in September. And at that point in time, they're going to see us that we're in a technical definition of recession. They see continued earnings deterioration. And I believe they turn less aggressive and perhaps only raise up to 3% by the end of this year. The economy can't withstand any more than that. And if, in fact, we are in a slowing economy, which I think we all agree that we are, one sector that we really like is healthcare. Two ways to access the healthcare sector: one through traditional large cap pharmaceutical companies like a Merck or a Bristol Myers Squibb. Another way is through the smaller cap biotech companies who are likely to be acquired by those large cap pharmaceutical companies with excess cash on their balance sheets. Names like Karuna Therapeutics or even Axum Therapeutics. We think the healthcare sector is certainly worthy of consideration in this environment.
Ron, I want to quickly get your take on the housing sector. We've seen a lot of down data this week. Existing home sales fall 5.4%. Home buyer sentiment plunged 12%. But yet we're stuck with this number, a median record price of north of $407,000 per home. Telling you what?
Well, I think it's old news, to be honest. I think that number is coming down. It's probably going to come down quite quickly. Rates are up significantly. That's slowing some of the home buying. So we would expect home prices to come down. One interesting thing to watch, I mean, housing is about 33% of the CPI number. And within the housing, home prices are about 80% and rents are about 20%. So it might be interesting to watch. You could have a scenario where home prices are coming down. That's actually going to pull down the CPI number. But a lot of people rent, and rents are only going up. And so you could have a situation where things are actually tougher out there than what the CPI is forecasting, just due to that imbalance in how the housing is broken down in the CPI number.
And guys, right now we're waiting for Snap earnings. They're expected to be out any minute. It was a decent day for Snap, but Kevin, year to date, the stock's off just about 65%. A lot of the focus is going to be on advertising spend. What are you looking for? Not so much in these specific results, but what we're seeing more broadly speaking in the social media space.
Yeah, I think the theme for Snap is still growing, but yet slowing. We're anticipating, I believe, earnings per share of around 4 cents. We believe daily active users have gone up, but still at the slowest growth rate in over 2 years. Revenue should have increased, but at the slowest growth rate in over 3 years. And I think that's indicative right now of the social media space and ad sales in this environment. So it's one area that we're not particularly optimistic about. Snap doesn't meet our selection criteria within our portfolios, but beyond social media, we really like the e-commerce space, and we think that has a lot of upside potential in the months and years ahead.
Still growth, but slow in growth. Great to have you in studio, Kevin Mon. Appreciate it.
Thank you.
Also, Ryan Bellinger with us today. Thank you both.
Well, inflation is weighing on the minds of many Americans, but how willing are we to adjust our lifestyles in order to make ends meet? Well, in our recent Yahoo Finance Twitter poll, travel is far and away the thing people are willing to sacrifice, leading to almost 46% of the vote. Now, dining out follows at over 34%, streaming at 13.7%, and self-care coming in last at under 7%, people not willing to give that up. But inflation is, of course, impacting all Americans. But from boomers to Gen Z, to what degree does it affect each generation? Well, for more, we turn to our next guest, Country Financial Director of Wealth Management and Financial Planning, Chelsea Moore. Thank you so much for joining us. So obviously, with inflation at a 40-year high, you have an entire generation who's never experienced these levels of inflation. Start off by telling us how this is mostly affecting Gen Z.
Sure, great question. What I think is interesting looking at the different generations is that as you go down in generations from boomers all the way to Gen Z, each generation feels a little less secure than the next one.
And that's not necessarily a huge surprise, right? When you take into account that baby boomers and Gen X have saved a little bit more than millennials and Gen Z simply because they have more working years under their belt. How, though, are you seeing a difference just in terms of how people are preparing for a potential downturn?
Yeah, I think what's interesting is looking at the data in 2020 and 2021, what we saw over those 2 years is that we saw excess savings. So this meant that consumers were able to create a nice savings cushion. However, our recent survey data found that more than half of the respondents were not willing to make a lifestyle sacrifice in the event of a recession. So things like streaming, dining out, entertainment, or pampering themselves. And so what we're seeing data so far this year is that consumers are no longer saving. They're actually starting to draw down those savings. And as that cushion starts to dwindle, and if we see inflation stay elevated, consumers' behavior is going to have to adjust. They're either going to have to cut the spending or rely on debt like credit card to fund those purchases. And you're right, baby boomers are much more likely to feel secure than younger generations because of that time that they've had to build the retirement savings, invest them, and pay down their debt.
Interesting to see all these businesses preparing for the potential recession and consumers not following their lead. An interesting number out today, 40% of workers are considering quitting their jobs in the next 12 months. That's on the heels of record after record after record of the Great Resignation. What do you make of the fact that in the face of all the things we've discussed, almost half of the country is still considering leaving a job?
Well, what I think is interesting is specifically looking at the millennials. Right now, they're in those prime spending years. So they're a large percentage of the population. And right now, they're starting families, purchasing homes, and they're trying to grow in their careers. So a lot of that big part is millennials looking for additional jobs. And with the big shift to remote, it just opens up so many more opportunities.
And we're seeing in that same study that the debt-to-income ratio of Americans born in the 1980s is higher than any other birth group. So whether you're Gen Z, a millennial, Gen X, baby boomer, what should be your priority in getting your financial picture together in this sort of environment?
Yeah, I think the first thing is to just work with someone that you know and trust. There are many firms out there that have done research on the value of advice. So working with someone you know and trust can really make that big difference in reaching your investment goals like retirement. The second one is just having a plan and staying on course. Times like this, it makes us have a really bad gut reaction and feel like we have to do something. But really the three biggest ways that you can make a change is save more, spend less, or change your goal like retire later.
All right, Country Financial Director of Wealth Management and Financial Planning, Chelsea Moore. Thanks so much for joining us.
Welcome back to Yahoo Finance Live. I'm Brian Sazi in D.C. at the Goldman Sachs 10,000 Small Businesses Summit. And I have a very special guest here, Goldman Sachs Chairman and CEO David Solomon. Good to see you.
Good to see you.
Didn't I just see you on an earnings call?
You did see me on an earnings call yesterday.
All right.
Well, you didn't see me. You heard me.
I heard you. Well, I'll take that as well. So really, the room is getting filled out here in D.C. A lot of small business owners. Lots of things top of mind with them. I talked to one individual that was concerned about how to fire an employee. Another one is worried about inflation. What do you think the biggest challenges of small businesses are right now?
Well, small businesses have had big headwinds over the course of the last couple of years. The pandemic was very, very tough on small businesses. But I will say one of the reasons we've brought all these small businesses together is to give them an opportunity both to interact with each other, share experiences, learn, but also to talk to their legislators about the support they need so that they can move their businesses forward. Small businesses are such an important part of the lifeblood of the American economy. Huge hirers, huge employers. There's no question, and we've been surveying them, that they're concerned about the chance of a recession, but they're also optimistic, and they're also looking for ways to continue to move forward. And I think there's some great messages while we're here in Washington about making sure we get appropriate access to credit and appropriate support to small businesses so they can continue to invest and continue to grow such a vibrant part of the U.S. economy.
You're right. Small business is very much the engine of this economy. Are they hunkering down?
Well, hunkering down, I think it's a little bit too big a generalization to say that all small businesses are hunkering down. I'd say all businesses, large and small, are being more cautious right now. There's more uncertainty around the economic trajectory of the country. Inflation is a big, big headwind, and it's a very, very tough headwind on small businesses. And so I think people are operating more cautiously, but I think people are watching, trying to figure out the trajectory of travel. People are investing in their businesses, trying to move forward, but I think with a little bit more caution.
I listened to your earnings call 3 times. That's just what I do. I had to do it. And
we have to find something better for you to do, because 3 times.
Yeah,
I mean, that's,
get in line, David Solomon, because a lot of people tell me that.
Maybe a Netflix show or something after the first or second
Fair
time.
enough. Okay, but I heard more caution in your voice than I heard 3 months ago. What made you say that?
Well, I think there is caution in my voice. I don't know on a relative basis to 3 months ago. I'd say 3 months ago I was pretty cautious too. We've had a bunch that's happened over the last 6 to 9 months as we exit the pandemic and we were starting to move forward. Obviously, the war in Ukraine was a big disruptor, but I've really seen, watched, and experienced through the eyes of our clients the growing imprint of inflation on the economic activity around the world. And it's a big headwind. And so I think that headwind creates caution. I think the path is uncertain. There are a lot of people speculating about a recession. There are a lot of people speculating about the trajectory of all this. What I'd say is I'm uncertain as to the trajectory of it all, but I know that the scenarios where we have a bumpy road ahead are certainly possible, and I think it's a time to be a little bit more cautious and really kind of tighten up and make sure that you're deploying your assets and your resources in places where they're very, very prudent decisions.
When does these double-digit gains, we're seeing inflation for many different items, when does that slow?
Well, it takes a while. Inflation is a hard thing to crack. I think the Fed's on it. They're starting to tighten monetary conditions. I think slowly we're starting to get some improvement in supply chains, but I think that's going to take some time. And so we've had a variety of real exogenous events from the pandemic and otherwise, the war, that have really kind of accelerated the inflationary environment. And it's going to take us a while, to get some real relief. But I'm hopeful that as we head through the rest of the year and into next year, we'll see a flattening out and ultimately a decline in inflation so we can get back to a more normal operating environment.
Has inflation become entrenched?
Well, I think right now, and I said this yesterday in my earnings call, that inflation is deeply entrenched. But that doesn't mean that we can't, through appropriate monetary actions, different policy actions, get back to a better place where things are more in balance. But at the moment, inflation is a big issue, and it's having a big economic impact on everyone. And in particular, it affects small businesses. It affects individuals across our country. And so we've got to really make sure we make the right policy decisions here to try to alleviate this economic headwind.
Is the right policy decision for the Fed, is that a 100 basis point move at their next meeting?
I won't speculate or predict a specific move, but economic conditions need to get tighter to break the back of inflation. And I think the Fed's focused on it, and they're moving in a direction, and hopefully we'll start to see some balance in all of this as they move in that direction.
As we move to that tightening economic climate or backdrop from the Fed, do you see more market volatility?
I do see a little bit more market volatility, but I think I think at this point the market is expecting, more aggressive tightening on the part of the Fed. I think where we have some volatility or softness in the market as we look forward is I think you've got to watch corporate earnings. And up to this point, corporate earnings have hung in reasonably well. But with a tightening economic environment, I think you're going to see more pressure on corporate earnings. And it's just math. If we kept the same earnings multiple on the S&P, but corporate earnings decreased by 10%, you can figure out what the market impact is. So I think the big thing to watch in the next 12 months is corporate earnings. If you're a student of history, anytime we've been in this kind of environment, a decline in corporate earnings lags and comes next. And that may put a little bit more pressure on stock markets.
When I'm not listening to your earnings calls 3 times, I'm reading all the economic research from your team, specifically Jan Hatzius. I believe he's at a 40% chance of a recession next year. Are you on board with that?
Jan, I think, is the best out there. He's an incredible economist, and his prediction, I believe, is a 30% chance of a recession this year. Or in the next 12 months, and a 50% chance of a recession in the next 24 months. And so, it's a data point. He's in the business of making predictions. I'm not in the business of making predictions. So we'll watch and see.
How do you plan to run Goldman Sachs differently into this tightening economic climate?
Well, we don't run Goldman Sachs differently. And I've been around in the business watching these economic scenarios for almost 40 years. I graduated from college in the early 80s, the last time we were coming out of a high inflation environment. We always run Goldman Sachs with a focus on our clients, trying to make sure we're getting our resources, our people, our capital, our financial resources directed at our clients. In an environment like this, we probably have to be a little bit more cautious with respect to the way we invest in the future and growing the franchise. But we always take a long-term view. We try to be very, very nimble and flexible. I think this environment demands that. And we'll stay focused on our clients. And we know if we do that, we do the right thing, we may see our business slow a little bit, but in the long run, we'll continue to perform. And that's where our focus is right now.
Do you see a spillover? So the economic climate overseas in Europe has really also taken a turn for the worse. Do you think that spills over to the U.S.?
Well, it's something I think you have to think about. I think the chance of a recession in Europe is certainly higher, given what's going on there economically and some of the policy decisions that have been made across the continent over the course of the last 5 to 10 years. A recession in Europe potentially knocks 1 percentage point off U.S. growth. And so we are globally connected. We do operate in a global ecosystem economically, and a slowdown in Europe will have an impact on the United States. That's something that I think our economists like Jan factor in, to their calculus when they're predicting the forward.
Maybe you could clear this up for us. I've seen some stories since the earnings report on hiring. Is there a hiring freeze at Goldman?
There is not a hiring freeze at Goldman, and just to be candid, I was disappointed. I went back and you said you listened to the earnings call 3 times. Mm-hmm. I went back and listened to it a first time. I participated the first time, but I listened to it. Dennis Coleman, our CEO, appropriately said we're looking at all our resources around the firm, financial and otherwise, and we are slowing the pace of our hiring. So we've grown the firm enormously over the course of the last few years. We've done a significant amount of hiring. We had planned to do meaningful hiring in the back half of the year, and we're slowing it down, but we haven't frozen it. There's certainly places where we're investing, and we'll continue to make those investments. And he also mentioned that we have a performance evaluation process that we do every year at the end of the year. We skipped it in 2021 coming out of the pandemic, but we're always looking at the overall headcount of the firm, and we usually call a few percent of the firm every year. That's been something we do, and we've done, the 20 some odd years I've been at the firm. We've always done that, and so we're going back to that. But there is no hiring freeze. But we're going to be more prudent and slow down our growth in this environment.
So you're bringing back that annual performance review. What do you think the results of that will be? Another, culling a percentage of the workforce?
We've always, it's one of the things that's important to understand about Goldman Sachs and the way, we operate. It's a very performance-based culture. We're always looking to make sure that people that aren't performing in our organization don't hang around, because it prevents us from giving the opportunity to hire more people that can really perform and add. Remember, it's a professional services firm. It's a people organization. We just are starting this week 3,500 new analysts who are just out of undergraduate school, over 300,000 people.
Wow, I feel old.
Well, I am old. You might feel old, but I am old. Over 300,000 people applied for those jobs. And so we have this great talent ecosystem, and we always want to make sure we're making room for young, excited, energized talent, to come into the firm. And so that's something we've always done. It's a return to normalcy for Goldman Sachs.
As a former analyst myself, and in the spirit of analysts, let me ask you 2 questions in one. Checking accounts, back half of the year, still rolling out?
Yes, that is our plan.
Okay, checking accounts. And then lastly, your 2024 targets that you put out Investor Day February, still on track?
Yes, and you heard me, since you listened to the earnings call 3 times. I said, I think twice in the earnings call, once in my script and once in a question, there's nothing about this environment that's changing our strategic plan for Goldman Sachs. We are continuing to invest in our core businesses, strengthen and grow these new platforms, which include transaction banking, asset management, wealth management, and our digital consumer bank, because we really think there's opportunity for us to diversify our revenue streams, have more fee income, more stable, predictable revenue base for the firm, and we think that will accrue in value to our shareholders. And so we're comfortable with those targets. They're 3-year targets. A lot of time between now and 2024. And, we don't manage the firm on a quarter-to-quarter basis. But we feel very good about the strategy we've put in place, and we're going to continue to execute on it.
Any Netflix suggestions for me?
I was told, I don't know what's Netflix and what's not, but the 2 things that, I've got a long trip. I'm going to Tokyo next week. And the 2 things that I was told to watch is one is called The Offer, which I think is about the making of The Godfather, and the other is called Severance. And so those are the next 2 things on my streaming list when I get around to it. But I'm a slow streamer.
Welcome back, everyone. Concerns of a recession are looming over investors as the Atlanta Fed now estimates Q2 GDP will contract by about 1.5%. That's negative 1.5% is what they're projecting there. Plus, over the weekend, a Moody's analyst said that they are hearing more recession talk than ever before. For more, we welcome in Citi Global Wealth Head of North American Investments, Kristen Bitterly. Thanks so much for joining us this morning, Kristen. The likelihood of a recession at a time of employment growth in the data as well right now, should we expect just a technical recession based on GDP contraction or a real recession with wider ranging implications?
So I think the question of a technical recession versus a real recession, we all know and we're all learning and reminding ourselves of what actually constitutes a recession in terms of the depth, diffusion, in terms of real contraction of economic activity. We certainly aren't there yet. So if we see a technical one, that could certainly happen. But I think the bigger question right now is really the balance of the Fed's trajectory and what they continue to do, as well as the strength of the consumer. Those are the two things that we're really going to be balancing out. And unfortunately, in terms of the data, and you mentioned this earlier in the program, the Fed is paying attention to trends. They're not going to look at singular data points. And so to really have clarity as to whether we tip over into a recession, and we would see that out in 2023, we're going to need to wait for the next couple of months.
Kristen, the reads on inflation that we have gotten have been, and they have continued to be shocking. You don't think that warrants a more aggressive pace of tightening from the Fed?
I think it's going to keep the Fed on the trajectory that it's currently at, right? So in terms of 75 basis points, clearly on the table, and that is our base case. We're seeing some abatement, obviously, in terms of whether it's gas prices, whether it's the commodity sector. I think the tricky part within inflation right now is really the owner's equivalent rents and looking at overall shelter costs. That's a part of the equation that has a lag and does have some stickiness to it. So the Fed has to really thread this needle in terms of determining what they have control over, what they don't have control over, and whether the medicine that they're providing is really the appropriate cure for the illness that the economy is currently experiencing.
So, Kristen, whether they raise 75 basis points, whether they raise 100 basis points, what they continue to do this year, are you as sort of glued to those small signals that they tend to give in their statements and to how much they're raising? Or do you think that do you think investors should be more focused on just the general trajectory that rates are going up?
I think that investors, you almost have to say, how do I prepare my portfolio for what could occur from here? So when we look at the percentage probabilities of whether we're going to tip over into a recession or whether we're just going to see this slowing growth environment, we give the slight edge to the slowing growth environment simply because of the strength of the consumer coming into this. But how do you prepare your portfolio for both of those situations? And it's actually creating some strong diversification within the portfolio across both fixed income and equities, and really leaning into quality and being relatively conservative when it comes to either stretching for yield or extending yourself when it comes to credit. So I think there is a portfolio solution here as an investor to remain fully invested, but ensuring that you have raised quality across both equities and fixed income.
We've already started to get some earnings out with banks really kicking things off and a few airlines as well. What types of either guidance, forecast revisions might you be looking out for even as we move on throughout the rest of this earnings season?
Yeah, so as we're looking at earnings, I mean, our expectations are roughly in line with analysts that we see around 4.6%. I think the one thing, though, to look through to in terms of earnings is when you strip out the energy component of that and the energy sector, you're actually looking at negative earnings growth. And so a lot of this has really been priced into the market overall. We certainly have seen that in terms of certain sectors and the expectations coming into earnings season. I think it's kind of looking out into the second half of the year, and the forward guidance is what's going to be most critical. And again, it all points back to consumer, because the consumer is 65 to 70% consumer spending is that percentage of GDP, and also looking at what constitutes durable demand. This is the key question across all sectors, understanding that if consumers are making those decisions in terms of their spending and recognizing that real wages have actually declined, where are they spending, how are they spending, and what is that forward guidance for the second half of the year?
All right, well put. Citi Global Wealth Head of North American Investments, Kristen Bitterly, always good to see you.
Solo mission today, huh? All right, here's how the markets closed the week on a high note. The Dow up 655 points, more than 2.1% on a Friday. The S&P up nearly 2%. And the tech-heavy NASDAQ a 201-point gain, nearly 1.8%. What a way to round out the week. Let's bring in Marta Norton, the America's Chief Investment Officer of Morningstar Investment Management, and Paul Kim, Simplify ETF CEO. Nice to see you. Marta, let's start with you. What drove this strong finish to close the week?
You know, it's kind of a microcosm of what we've been seeing really year to date, with the market selling off, having some relief rallies as we continue to process what the impact is going to be of inflation, what the impact is going to be of the interest rate hikes that we're seeing, and how strong the economy really is and whether it can weather it. So I think today, as we start to see and for the broader week, take a look at earnings and get a sense for some of these companies, some of these banks that are potentially healthier than maybe people had thought. I think that gives a little bit more momentum to the idea that maybe the recession, if it's here, won't be as severe as people expect.
Paul, what do you think? Are you in the camp that we might already be in a recession? And I guess if you are, if you aren't, how bad could it potentially be?
There's more art than science to a recession, so I think technically we're probably pretty close, but it's a judgment call because we haven't seen these same set of factors, right? With a very healthy job market, with nominal GDP growing at such a high rate because of the high inflation, while at the same time starting to see some of the technical triggers of a negative real rate. So it's a mixed bag, and that's kind of what we're seeing in the market, right? It's volatility on both ends, and today it's a very positive volatility day, but we've had plenty of recent negative ones.
And Marta, when you're trying to plan for the short term versus long term, we saw financials doing well today. Obviously, a lot of that news coming from the bank earnings today from Citi. But what is your longer position in financials? How do you see them as a hedge against inflation and potential talks of recession?
Sure. So with financials, we actually don't think they're a great tool for inflationary periods whatsoever. And I think that's some of the concerns surrounding financials, surrounding banks. They do tend to do better when we start to see interest rates tick up. So that's in their favor right now. But when we're taking a look at financials, we're focused less on the near term. In fact, any sort of near-term volatility is actually more of an opportunity for us to maybe increase our position. And we're focused more on this long-term estimate of what their fair value is. And so for us, banks and financials are a bit of an opportunity. When we survey the U.S. market, we think banks and financials more broadly are one of the more attractively priced areas. The market in general entered this period at pretty high levels of valuation. So even though it's come off, it still seems expensive to us, to some degree, but financials a bit less so.
Paul, you say you're not buying this narrative about having hit peak inflation. You see a stagflation base case. Why?
Well, for one, we just had a 9.1% CPI print. So whether it comes down from there, it's still very, very high historically. So I think inflation is here to stay for a bit, right? At least maybe a couple of years even. And in the backdrop of that, you're starting to see the sort of tightening start to bite and the recessionary pressures building. And so that combination, again, very unusual, is not really something that we're used to and certainly not seen in about 4 decades.
So, Paul, what does that mean then for Fed policy? Does the Fed need to get very aggressive, do that 100 basis point hike at the end of this month? And then what does that mean for the fall?
So what they will do versus what they should do is a kind of a debate. So what they should do for a supply-driven stagflationary pressure is really help encourage investment, right, which is ironically lower interest rates and help sort of build a case for fiscal stimulus and sort of productivity gains. But what will likely happen is what the market is pricing in, which is doing something about inflationary pressures today, and that's raising rates in the face of slowing growth. And so that's the conundrum. Long term, we should be encouraging investment, but near term, it's very likely we're going to see the opposite.
And Marta, I want to ask you about the strong dollar, perhaps opportunities that you're seeing in non-US currency, but also some of the risks that come with that in this sort of environment.
Right. I think the currency question is a real conundrum for us. So as we look at the valuation, say, of the yen or the euro, those look attractively priced to us, actually at pretty steep discounts. And, you can take a look at the US dollar relative to the euro, and it's, at parity, which we haven't seen in decades. So that, at least from a historical basis, looks like a valuation opportunity. But then when you think about the dynamics that are at play, the Fed policy here, the policies that we're seeing overseas, what that can mean in terms of how investors are incentivized to kind of prioritize one currency over another. And then when we think about economic risk, All of those factors are at play. So for us, there's certainly a valuation case for some of these exposures, but there's also a reason to temper, position size so that you're not overexposed to what could be some fundamental headwinds.
Paul, a number of guests yesterday telling us cash is king in this environment. And given what the markets just did today, hard to buy that number. You say energy is king. Where are the opportunities at this juncture?
And I agree. I think we just discussed currencies, but if you put a filter of energy independent markets and economies versus those that are net importers, I think that's a pretty good way to explain a lot of the currency relative performance. And so I think energy is the biggest driver, the biggest wild card, whether supply is going to be able to meet even diminishing demand, all the geopolitical risk that's still out there, as well as just a lack of investment over the past decade or so. And so you just have a deficient amount of supply, and how it plays out is the story. And I think that is very much on everyone's radar and should remain a big driver, because that, I think, explains a lot of the narratives we're seeing today.
And Marta, when we're trying to dissect some of the narratives that we are seeing today, a lot of it is tied back to the consumer. And we got that retail sales number out this morning. It was better than expected. We saw that 1% move higher. Is the consumer even more resilient maybe than we initially thought?
I guess when I think about the dynamics that we're in today relative to historical, brinks of recession, I think you can argue that the consumer is healthier today than previously. You can point to the pandemic packages that helped the consumer. You can point to the fact that consumers weren't spending a lot of money for a few years' time. So there's this kind of pent up wallet that they have, I guess, so to speak. But I think as we think about just a relative contrast, potentially we are in better shape than we have been historically. That doesn't mean that the consumer can take endless amounts of inflation, but it does put us in a better position. And I think is one reason why the market is kind of seesawing back and forth between trying to price in what could potentially happen here.
All right, Martin Norton and Paul Kim, thanks so much for joining us.
Lots to dive into when it comes to markets today. We have another round of weak bank earnings from Wells Fargo and BlackRock. June retail sales were solid, though, seeing the markets probably trade off of that a bit. And now, Julie, we're coming up against a new read on consumer confidence. You've been teasing this report all week.
There it is. It's better than expected. 51.1 is the read here on the preliminary University of Michigan read on consumer confidence. 50 was the estimate from economists. So remember, the reason I keep bringing it up is I'm not just pulling it out of thin air here. This was really the report, aside from the last month's inflation report, that really put the Fed over the edge and made it decide to raise rates by 75 basis points. So now coming in better than estimated, 51.1 versus that 50 estimate could be reassuring. Current conditions, much better than estimated at 57.1 versus the 53.7 that was estimated by economists. Expectations not beating by very much, 47.3, just 0.3 of a point better. And the inflation expectations still relatively elevated, but again, a little bit better. 5.2% is the survey expectation for inflation 1 year from now, 5 to 10 years from now, coming down to 2.8%. So on balance here, a more positive tenor in this report than was expected.
Glad you called out inflation. The report saying, quote, the share of consumers blaming inflation for eroding their living standards continued its rise to 49%, matching the all-time high reached during the Great Recession. So obviously inflation top of mind amongst households, concerning outlook. But look, then we had those June retail sales results. So it's clear consumers are out there in some capacity buying stuff.
Yes, it is indeed. I mean, I think the question is and remains, what are they buying? How are we seeing the shift around in those consumer spending patterns? And then how is that going to affect the overall pace of inflation and therefore the Fed by extension? But I think, you do have a lot of Fed commentary out over the past 24 hours. Most recently, we had Jim Bullard making some comments on the tape. He's at an event in Europe, and he's talking about inflation. And he seems to be indicating that the Fed is more leaning towards 75 basis points. That's sort of been the balance of the commentary we've heard, is my takeaway, at least over the past 24 hours or so. And this number, I think, would kind of maybe confirm that.
Yeah. Now we just need some more housing data, I would say, to really put the kibosh maybe on that 100 basis point potential rate hike. Now, here are 3 things you need to know right now on this Friday morning. More data on the consumer front today as we got a look at June retail sales. They came in better than expected at an increase of 1% for the month of June. The month of May was also revised to negative 0.1% from negative 0.3%. Well, Julie, looking at these numbers, don't look recessionary to me.
Yeah, maybe not. But Brian Cheung can tell us more about what they showed with these retail sales numbers. So we saw, a little bit better than an expected number, but especially when you strip out autos and gas, which was sort of notable to me.
Yeah, well, I mean, the challenge with this report, and I think Sammer actually helped frame this pretty well this morning on Twitter, but it was going to be bad either way, because if the report came in lower than estimated, well, the expectation is that actually shows signs of recession already happening with cratering demand, right? That means we're in a recession. But if it came in hotter than expected, then the inflationary story is very much still valid. Fed's going to have to hike more aggressively. That means we end up in a recession. So either of those scenarios is not good, obviously, but again, if you just look at the numbers themselves, what it tells us is that the American consumer is still out there very much paying those prices that are rising. You have to consider that the retail sales number, you should adjust that for inflation. Now, at the same time, it was about above estimates. When you consider 1% increase in the month of June compared to 0.9%, which was what the street expected, either way you cut or slice it, this is something that the Fed's probably going to have to react to. It could add some steam to a 100 basis point, 1% increase from the Fed in about 2 weeks.
You are a true 12-tool player there, Brian Cheung, talking some retail sales and some Fed. What stood out to me here, non-store retail up 1.9% month over month. That was very good. Furniture up, electronics up, food and beverage up, pretty good. So consumer, they were hanging in there. But what was down, what if I needed a red flag in this report, it was some of the discretionary categories like clothing, health and personal care. So it's not like the consumer was out in June spending willy-nilly. They were making tough choices of what to buy or not to buy in this inflationary backdrop.
Well, and it's hard to back out. When we have the individual retailers, usually they will tell us what the volume increase was versus what the price increase was. When we have these macro numbers, we don't necessarily know of those increases, how much of it was because prices were going up and how much of it was because people were actually buying more stuff. So we'll have to sort of parse that in the individual companies.
What Waller said yesterday, he was looking for some hot reads.
Yeah. And this
is hot. This is hot.
Yes. But it's not just retail sales. So he made a speech yesterday where he said, as of the 2 readings of inflation that we got the last 2 days, right? CPI on Wednesday, the PPI yesterday, he still felt like a 0.75% increase would be okay at the end of this month, but contingent on what retail sales looks like, what housing data looks like, and also what inflation expectations figures look like, which means that he's probably going to be paying attention a lot to the consumer sentiment numbers that we're going to get later on today around 10 a.m.
Julie Fave?
Right?
Yes.
Very much. Well, I mean, that was the big pivot, actually,
yes,
that led to the June increase being a lot higher than expected. So we're going to have to see the string of other data. It's possible that they could come in softer than expected, which might further increase the case for a 0.75% increase in the Fed's next meeting. But look, I've been refreshing very frequently the Fed funds futures markets, and in the response to the numbers that we got this morning from retail sales, because of what Chris Waller said yesterday, you saw more steam go into odds of a 1 percentage point increase. Now about 52% is what the markets are pricing in this probability.
Well, the inflation story is so prevalent, it's become a meme born out of a TikTok trend. We're paying more for everything, from the gas pump to the grocery store and everywhere along the way. It takes the ultimate optimist to find some good news in the latest report, but we couldn't find one. So instead, we tapped senior columnist Rick Newman to go out and find some. What'd you find, Rick?
That's more like it, Dave. You called me Mr. Sunshine once, and I almost had a heart attack. The reason that I'm trying to spin it this way is because I've been tracking a bunch of consumer categories in the inflation picture since way back into last year, and noticing a lot of changes. And there actually were some important changes in the numbers we got earlier this week. So in a few categories, most notably new cars, used cars, rental cars, and transportation overall, we've seen a huge decline in the rate of inflation. If you remember back to January and February this year, used car inflation was 40% or higher. And no, I mean, we've never seen that before. That was just wackadoodle.
And used car inflation, this has come down to the 7 to 10% range. New cars, we're still seeing high inflation there, but it's not what it used to be. And what this tells us is that the supply chain issues that were causing a shortage of these products in the first place, that we're working these things out. So that's actually good news. Now, there are other categories where inflation is getting worse, not better. The most obvious one is gasoline, 60% increase year over year in the latest numbers. But there are a couple other ones there that are really important to pay attention to. Gasoline gets all the attention, but household energy is up by more than 20% year over year. And the typical household spends more on heating and cooling their home and hot water than they do on gasoline. So household energy, that's going the wrong direction. And then just housing costs overall, they are up by about 7%. That is lower than the overall rate of inflation, now 9.1%. But Americans spend a third of their budget on housing. So those are the things that are going in the wrong direction. So it's a mixed picture. There's a lot of bad news, but there's some not so bad news.
And so, Rick, how much of that is about demand destruction? People perhaps giving up on trying to get a new car, given how much some of these monthly rates are and just how expensive cars are overall right now?
Well, there's no simple category that says this amount of inflation or declining inflation is due to demand destruction. And there's also the question of what's the difference between destruction and deferral. So there is demand destruction happening with regard to things like gasoline. I mean, if you combine 2 trips into one today, that's gasoline. That's some gasoline you're not purchasing and you are never going to purchase. But if you think that a car is too expensive right now and you want to wait 6 months or a year, that is deferred consumption. And that's actually, I mean, these are all actually good things. I mean, consumers do have choices. We are not automatons who just go out and spend the same amount or buy the same amount of stuff no matter what the price is. We make rational decisions. And that's one of the things that probably will bring the inflation rate down during the next few months. Now, I was wrong. I thought inflation had peaked a couple of months ago when it hit 8.3%. And I was wrong about that. It went up to 8.6% and then now up to 9.1% still. I think we may be at the top now, and there are reasons to think we're not going to see inflation back to 4% by the end of this year, but we could see it under 8%.
Rick, the Biden administration should listen to you because you just listed out a number of things in that inflation report that were actually pretty good. I haven't seen the Biden administration change the messaging like that. Am I missing something, or why aren't they latching on to the good parts of this report?
Well, you should call them up and tell them they need to start reading my columns and passing them around.
I will.
In the presidential daily briefing. But the White House they've been focusing on a different message or spin, if you prefer, this week. So they knew, like a lot of economists, that this number was going to be hot. And they were actually doing briefings beforehand. Now, they said, we don't yet know what the inflation number is, but they were trying to point out that the energy prices that go into these the June inflation numbers, this is actually old data. And they're right about this. I mean, the gas prices have actually fallen by almost 40 cents, I think, at this point per gallon since June. So gasoline prices peaked at $5.02 in the middle of June, and that's right around the time that the government was gathering the inflation data. Gas prices now, as you can see there, down 40 cents to about $4.60. And we know from the price of wholesale gasoline, which continues to go down, that we're going to see lower gas prices still because it takes a few weeks to get that transfer from the wholesale level to the retail level. So that's what the Biden administration was focusing on this week. And I think the reason is they're just obsessed with gasoline prices because Biden's the first president who ever had to explain gas prices that started with a 5. On average, and he needs to get them down to prices that start with a 3 on average, and we're not quite halfway there, so there's a long way to go.
Yeah, it's an issue that a lot of voters focus on. Rick Newman, great to see you. Thanks so much for joining us.
Again, we were just talking about the PPI and just kind of the inflationary story. To Akiko's question, do you see any signs in the PPI and the CPI, despite the strong headline number, of perhaps a better story on inflation for July, August, maybe later on?
Thanks for having me on, and I do. I'd like to pick up on a point that you two just made. The data is somewhat backward looking. That's actually a critical point. The reason markets are worried is because the Fed now is very focused on headline inflation, even though it's backward looking. Fed Chair Powell recently said this is not a time for a lot of nuances about headline and core. And so the concern is that with high headline inflation, potentially weakening economic growth momentum in a very aggressive Fed on rate hikes, a lot of concerns about the business cycle rolling over in an eventual recession are out there. So that's hitting markets hard. But let's look at the front edge of the inflation trade. It is collapsing. The dollar is up 15% year to date. Copper's down more than 30%. Broadly, metals are down almost 30%. Forward-looking bond market inflation expectations, and this is good news, are down sharply, well over 100 basis points. So that's actually helping the Fed tighten. If the Fed is lifting the nominal policy rate against the backdrop of falling long-term inflation expectations, then the real policy rate, deflated by expected inflation, is moving up quite rapidly. And so we have tightening monetary and financial conditions that will help to bring inflation down. It will also slow growth. So we're going to have those recession concerns that are lingering. But I think that really is a critical point. The data is backward looking. We're going to get some better news on headline inflation in the back half.
So, Michael, let's talk about what we have seen over the last few weeks, which is not necessarily reflected in the data. We were talking about commodity prices coming down. Obviously, energy has been a big part of the spike we've seen in inflation. We're looking at some food costs coming down as well. I mean, how do you look at that data right now in the context of the bigger picture? And what does that tell us about where we are, whether in fact we're close to the peak?
Yeah, I think we are very close to the peak. I mean, this very well may have been it this past month. And in my view, I mean, I was quite worried about inflation and quite worried about the Fed being behind the curve. I mean, the last few times I was on the show, we talked a lot about that. But we change our view when the facts change. And if we look at these sensitive forward-looking indicators, they're telling us that the Fed is rapidly catching up, that monetary conditions are tightening. Growth will slow, nominal demand growth will slow with a lag, and inflation will slow with a double lag. It is a lagging indicator. But on the headline inflation, I think we're going to get some better news very soon because of these falling energy and food prices now, very important. The strong dollar, inflation expectations coming down. That's actually a very good story that the Fed's medicine is starting to work. Now, we can talk about recession risks, but the first step in terms of dealing with an inflation overshoot and being behind the curve is catching up, and they're effectively doing that now.
How about the risk of the recession being induced by too rapid of a Fed tightening when you consider markets kind of pricing in that the Fed is more likely than not to do that 1 percentage point rate increase at the end of this month? You have Chris Waller, the Fed governor, the most significant member so far, saying he still expects 75 basis points, but it depends on incoming data, retail sales, and housing going to be the key there. You think that's the right stance?
Yeah, I think certainly the business cycle risks rise when the Fed is moving rapidly to catch up. It's why you don't want to fall behind the curve to begin with, because catching up means that there's a greater risk of going too far and then having a recessionary outcome. But that's where we are. I think it would be better if the Fed were more focused on some sensitive forward-looking indicators like those bond market inflation expectations from the TIPS market. That's telling us that what they're doing is working. They're getting traction. And so we don't necessarily need panicky rate rises way beyond what the market expects from here. If they do 75 or 100, I think there's probably going to be a strong case for slowing it down or even pausing after that. Policy does work with a lag. In the forward-looking sensitive market, they're telling us the conditions are tightening pretty sharply here. So it's a bit of a dicey situation. I would note this. Parts of the yield curve are inverting now. That's creating consternation. The T-bill yield is still below the rest of the coupon curve, but it really is narrowing pretty rapidly. So that will be something to watch for if the Fed goes 75 or 100. We'll probably have a pretty flat T-bill to coupon curve. If that goes inverted, then I think the recessionary risks are pretty dramatically amplified.
Inflation at a new 40-year high, rising 9.1% in June. Now, one of the biggest contributors, the cost of food. The food indices, both at home and away from home, rose 1% in June. Yahoo Finance's Alexandra Canal joins us now with more. Ali, obviously, this is tough. Food is close to home for everybody.
That's right, Rochelle. And it really is disappointing to consumers. The food category continuing to see those price increases up 1% over the month, but a whopping 10.4% on an annual basis, which is the biggest 12-month increase since the period ending February 1981. So prices just continuing to skyrocket and reach new record highs. If we look specifically at grocery store items, you'll see that the prices of cereal, bread, chicken, all seeing increases on a month-over-month basis. But we did have some positive news with bacon prices falling for the second straight month in a row, in addition to prices declining for beef and veal. So meat lovers can find a bit of solace in that. But year over year, really across the board, we're seeing double-digit price increases for a lot of those basic food items that I just mentioned. Eggs, for example, that's up a whopping 33% compared to June 2021. So just another month of hotter than expected inflation data, and certainly discouraging to consumers.
Boy, that is a massive number, Ali. Inflation also seems to be hitting consumers' coffee addiction. Visits to Starbucks and Dunkin' are down for the month of June. Is that right?
That's right. And as a coffee enthusiast myself, it pains me to say that consumers are shying away from their daily cup of joe, at least at these big coffee giants. According to foot traffic analytics platform Placer.ai, coffee visits dropped below quick service restaurants for the first time all year during the month of June. Now, this is due to a combination of factors like inflation, high gas prices, the rise of COVID cases. But what's interesting here is that throughout the pandemic, coffee's actually outpaced other dining categories. Consumers really were flocking to their favorite chains despite the pandemic, despite rising prices. But June just delivered that blow to that pricing power. Monthly visits to Starbucks were down nearly 8% year over year. Dunkin' also down nearly 5% on a year over year basis. But pre-pandemic foot traffic levels, Dunkin' is relatively on par to where they were in 2019. Starbucks, not really there, still off about 7%. That could be to Dunkin' being a little bit more affordable when it comes to coffee compared to Starbucks, which we know is important to those value-conscious consumers. But the report did say that both chains' visit gaps are relatively small overall, and that customers could just be temporarily adjusting their behaviors to match the current economic downturn. But over the long term, the expectation is that these foot traffic levels will bounce back to normal.
I got to tell you, I am driving less, but not drinking any less coffee. Ali Canal, thanks so much. Great stuff.
Consumer prices rising at the fastest pace since 1981 last month, a headline increase of 9.1%. If you back out food and energy, still an increase of 5.9%. Any way you slice it, people paying a lot more for a lot more stuff. We're joined now by Brian Deese, White House Director of the National Economic Council. Brian, thank you so much for being here. I want to start on those energy prices because I know that's something that you at the White House have pointed to as now a source of some relief. That's something we've been talking about as well. The prices at the pump have come down. But energy prices are volatile, so there's no guarantee they're going to stay down. So how do you address that issue?
Well, thanks for having me. I think first, you are right that these numbers that came out today are outdated in the sense that they don't reflect the significant decline in oil prices and gas prices that we've seen. Gas prices at the pump down 30 days straight, down about 40 cents. So this number that came out today, about half of it is driven by energy that is outdated. But that's also why economists tend to look at what is referred to as core, which strips out energy and food. That number, as you say, 5.9% now, down below 6%, but still too high. So I think the most important takeaway from this is that we need to keep acting urgently to bring prices down. It's why here at the White House we're so focused on trying to urge Congress to act on legislation that would bring down costs for consumers on things like prescription drugs, on things like semiconductors that go into almost every durable good produced here in the country, but also reduce the federal deficit, which would help to provide a complement to what the Fed is doing on monetary policy. All those things are within our sights, within our reach. We could get those things done. I think this report underscores the urgency of moving on those measures this month.
Brian, let's come back to energy for a moment, because yes, all of those things are obviously important input costs. Yes, economists look at core. Consumers look at the pump, right? They look at what they are putting into their vehicles, and that definitely informs consumer confidence and informs things like polls, of course, as well. Of course, the president is going to be heading to Saudi Arabia to try to get some relief on production from there. But talk to me more about the White House's plan on the energy front.
Absolutely, and you're right that consumers feel it when they drive at the pump. That's why this decline for the past 30 days is so important. Prices are coming down. They're down 40 cents nationwide. There's about 10,000 gas stations around the country where gas is now under $4 a gallon. And importantly, if you look at where oil prices are now, while gas prices have come down about 8% from their peak, oil prices are down about 20%. So that means that there is more room for gas prices to come down. They should come down as quickly as possible, and markets at least are signaling that they will continue to come down. That's important, good news for consumers that, as you say, are filling up their gas tanks every day. From our perspective, we're focused on doing what we can to keep that dynamic going. That's about increasing global supply. That's what the president was focused on with the G7 in trying to work toward what we refer to as a price cap on Russian oil. That would maintain stability in the global supply of oil while really focusing the economic pain on Vladimir Putin. That's why we're focused on releasing 1 million barrels a day from the Strategic Petroleum Reserve, which we have seen has had an impact on helping blunt the run-up in oil prices, and why the president has called for Congress to move beyond that act to provide a short-term elimination of the gas tax holiday. These are all things we're focused on, we're moving on, but the goal is to try to keep that momentum going, because as you say, a lot of things are important, but the fact that gas prices have now come down 30 days in a row, that is important for a lot of people across this country.
Brian, indeed it is, and I hear your point, and it's a point well taken on gas prices. But when I dig into the CPI here, I see the index for butter and margarine up 26.3%. But that's huge. Dental costs, highest since 1995. Is the only thing that is going to bring down prices like this is a recession in this country?
Look, I think if you look under the hood, you see a lot, right? Meat prices down this month, the price of eggs down this month. Overall, food at home, the food that you buy in a grocery store, some moderation from the increase from last month. And if you look in commodity markets, again, to the fact that this is backward-looking data, since June, you've seen, for example, a 30% decline in the global price of wheat. But look, none of that matters at the end of the day for typical families who come into a grocery store, and the bottom line is prices are too high when they're buying groceries or they're buying gas. And that's why I will come back. We need to take action. This president is focused on taking action wherever we can to lower prices for consumers. Congress has on its plate right now ways to do so. We talk about legislation that would lower the cost of prescription drugs, lower the cost of utility bills that families pay. Why that matters? A typical family at the end of the month, if they're paying less on prescription drugs, if their utility bills have come down because we've provided long-term incentives for cleaner but also cheaper American energy, that's going to provide some relief to those families that are having to pay too much. So look, there's a different pictures. We are seeing some food goods come down, others too high. But at the end of the day, what we should be doing is acting to bring down costs for consumers.
Headline CPI rose 9.1% in the month, raising fears in the markets of a more aggressive pace of rate hikes from the Federal Reserve. Let's bring Yahoo Finance's Brian Cheung on this. Brian, double-barreled question. One, what drove some of these increases, and what are the implications for the Fed's next move?
Yeah, so let's start off with the first bit of that. Again, if we unpack the numbers that we got about 30 minutes ago from the Bureau of Labor Statistics, you can see on a year-over-year basis, prices increased in America by 9.1%, above the street's estimates of 8.8%, so a hotter than expected report. Again, that's the hottest pace that we've seen since November of 1981. On a month-over-month basis, prices increased by 1.3%. Now, the Fed might argue, let's take a look at the core CPI, which strips out those more volatile components like, for example, food and energy. And when you take out those elements, you do see a lower inflation report of 5.9% on a year-over-year basis, 0.7% on a month-over-month basis. But of course, you're going to have a lot of Americans saying, well, food and energy are the most important parts of my daily consumption, so why would we strip that out? And indeed, when you do look at the prices of gasoline, fuel oil, things that Americans were spending a lot of money on in the month of June, you did see increases on a month-over-month basis, 11.2% on gasoline. Fuel oil did decline by 1%. Food, though, increased by 1%. You take a look at some other components of the CPI as well. Interesting to see the reopening play. Actually saw some prices decline. Hotels and motels down over 3%. Airline fares, car and truck rentals down about 2%. But take a look at owner's equivalent rent. This has been an argument for the more delayed bleed into higher inflation, increasing by 0.7%. That shows an acceleration, actually, of inflation in what is a very large percentage of the average household expenditure, guys.
Is there anything that we can extrapolate this to really show where consumers are pushing back on the prices that they do have to pay right now?
Yeah, certainly. I mean, there is demand destruction in some of those larger durable items. When you take a look at TVs, for example, declining by 2.3% on a month-over-month basis in this report. But again, you look at that headline number, yes, you can maybe make it look a little bit better by taking a look at the core number, but it is still hot, whether or not you look at a core reading or a headline reading. So across the board, there is still a lot of demand. A lot of companies that are supplying either services or goods are continuing to raise prices as of the month of June. But keep in mind, the price declines that we saw, at least in what you see at the pump, didn't start to happen until a few weeks ago. So that really isn't reflected in this June report. That's a reason why you have some economists saying the July report could show signs of perhaps some easing. But look, from the report we got 30 minutes ago, you're not seeing that quite yet.
Well, and I'm also curious, not just are we going to see some easing in gasoline itself, but then the feed through to everything else, because gasoline is a factor and oil is a factor in so many of these other costs, right? Obviously, they have implications for airline fares. They have implications for food in terms of delivering the food and the prices that are being charged. So we know we're already seeing prices at the pump go down. How quickly does that tend to filter through into other stuff?
Yeah, well, I mean, there's a lag effect to all of this, right? Mm-hmm. And I think the first thing that you'll start to see, and probably the most accurate real-time number that we get, which is not all that real-time because this report comes out about a month of a lag, right, is in the gasoline and oil prices, right? Because that has to bleed through to everything else. If oil prices get a little bit cheaper, that makes the input costs for businesses a lot cheaper as well. But that's not going to happen overnight, even after we've seen the price declines in the beginning parts of July, for example. You might not see that impacted into other types of non-oil categories until the later months of this year. In the same way that you're seeing some impacts from this inflation report that are actually increasing, providing more upward pressure, not start to reflect themselves until the summer months of this year, right? Again, I was talking about owner's equivalent rent. You didn't see that tick up until really the middle and the beginning of this year, even though people were saying and anecdotally providing evidence that they were paying more for mortgages, paying more for their rent at the beginning or at the end of last year. So again, this really paints a very difficult picture for the Federal Reserve, which gets at the second part of your question, which I totally ignored.
Thanks
Brian,
for not forgetting.
I did. And you're starting to see that the Fed is going to be under more pressure to break the credibility promise that they've already made in the last meeting when they said we're going to go by 50 or 75 basis points. You have markets now pricing in, I just checked a few minutes ago, a 30% chance of a 1% or 100 bips, as the smart people like to call it, interest rate increase at the end of this month. Again, that's doubting what the Fed has said so far. And that's very much understandable when you say, well, this inflation print was much hotter than expected. Wouldn't that require higher interest rates to try to take that demand down?
When is the Fed blackout period? Because now I'm thinking back to that journal story that came just before the last Fed meeting where they floated a higher pace of rate hikes. Do you think we could see something like that?
Yeah, so we're not in the blackout period right now. So there's no reason why a Fed official or even Jay Powell himself can't come out in the next, let's say, few days and say, hey, here's our reading on the inflation report. We're going to do this at the end of the month. The blackout period does, however, begin at the beginning of next week because the next policy setting announcement is going to be on the 27th as scheduled. So they'll stop speaking around essentially Saturday through the 9 days after that period. Now, again, we don't have any scheduled remarks. The only other Fed governor that we're expected to hear from is from Fed Governor Chris Waller tomorrow morning. That's definitely going to be one to watch in response to this. But again, all the commentary leading up to today has been it's either 50 basis points or 75 basis points. Philly Fed President Pat Harker said that on our show a few weeks ago. That hasn't changed from anyone. Does this report change that? We'll have to see.
And we have University of Michigan confidence on Friday, which is also going to be.
That was a big part of the pivot for the June meeting.
Yeah, so we'll see what that shows.
Certainly. If BIPs are what the smart people are saying right now, I'm going to start using that everywhere.
There you
Sports
go.
games,
Good move.
Wawa,
Good move.
Anywhere, bars,
Bips.
BIPs. You guys are going to get these BIPs.
By how many bips have your eggs gone up, for example?
Many bips.
Many
All
bips.
the bips.
We can check that. We can check that.
Big
Eggs
bips.
went up by, let's see, 0.3% month over month.
Still bips.
30 bips.
Bips. Some people say beeps. That's a Jared Blakely special, beeps.
We're going to have to workshop that one.
Yeah.
All right. Thanks so much, Brian Cheung, joining us here on the day to break down all things CPI.